India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Friday morning. We're coming to you from the CNBC-TV18 Motilal Oswal studios, and it's a big day. It's the big day because the bigger day is tomorrow, and then the biggest day is on Tuesday, which is next week on Tuesday. But, you know, we're getting into all of that. So this is the last session where you'll be able to sort of, if you have a view and if you're so inclined, to take a view on which way elections, etc., are really going to fall, which side of the fence they're going to fall. I'm Prashant, with me my colleague Sonia and Nigel. Guys, good morning.
Hi, good morning. The adrenaline is going to be high, right, over the next couple of days as we get a lot of news flow. But I think, give and take everything, this is a market which is set up for perhaps a move upwards. Yeah. The Nifty is down 600 points from its peak, so at least there is that little bit of leg room.
Yeah, plenty of domestic as well as global cues is what we'll get over the weekend, but it's the end of earnings season as well. And I think I've been here for 55 earnings season, so normally you breathe a sigh of relief. Yeah. But this time around, that's not the case because you have plenty of cues coming up. So brace up, buckle up and get ready. We're only getting started, it seems.
We have the GDP numbers later tonight. I mean, that's backward looking. But then I think the elections will overshadow everything else, global, local, everything. And I think that's what I want to begin the sort of setup this morning with. The fact that election exit polls, which are due tomorrow evening. Now, remember, there used to be a time 10 years ago, actually even maybe it's only been the last 10 years, if my memory serves me right, you used to get election exit polls after every phase. So, you know, people exit the booth, the pollsters will ask them, which way did you vote? They'll take it down, and by the time in the evening the polling is done for that phase, you'll get the exit poll results. But of course, now Election Commission has barred that, so you get all of it together, and that's going to be that'll start to flow in from 6:30 p.m. tomorrow. I think, a lot of chatter tomorrow evening, day after tomorrow on Sunday, and then, of course, on Monday as well, which is when market will react to exit polls. And mind you, I have to say that exit polls broadly sort of get the direction right. They kind of they did underestimate the extent of the victory in 2019, 2014, but they kind of broadly get the direction right. So we'll kind of see which way they swing. And if it's really one way, you'll get a big reaction on Tuesday. So instead of on Monday, which is the first trading session after the results come through, and then, of course, the actual ones will follow on Tuesday. Now, overnight, for what it's worth, equities were weak. So U.S. equities were down about 1% on the NASDAQ. S&P was down about 0.6%. 10-year was down 7 basis points. We're back at about 7.5%. Dollar index is down about 1/3% from 105. We're down to about 104.78. So the worry so far has been the fact that, you had basically a senior Fed official a couple of days back saying that he doesn't see the visibility for rate cuts. Market reacted hawkishly in the sense that rates market jumped and equity sold off. Now you've got data which came through last night, 2 sets of data points, which suggest that the things are starting to cool down. So the first one, of course, was the revision to first quarter GDP in the US, which showed a bigger slowdown than what people were forecasting. And by the way, in both components, one is consumption and the other is price measures as well. The slowdown was observed. And, it kind of is perhaps a sign of things to come. You also had weekly jobless claims. At an absolute level, if you look at this compared to the last many months, this is still extremely at low levels. So it's not as if it's kind of, gone through the roof. Jobless claims, that is, you want this number to be not very high, but not very low as well, because very low means tight labor market. But this also is starting to see signs of a little bit of easing, and this is important. You also had another Fed official, Fed's Bostic essentially, and he made these comments after U.S. markets closed. He said he does not see rate cut in July, but he said that, post-July will be data dependent. And in terms of further data, tonight out of the U.S., you have the PCE data, which basically will once again give a broad measure of how inflation is really progressing. That is later tonight, the PCE number. And by the way, it's something which the Fed also watches pretty closely. Oil prices have come off. They're down about 2%, so that's good news. We're at about $82 per barrel on Brent oil prices. So where does all of this leave us? On the Nifty, we yesterday flirted with the 20-day moving average. We actually hit the 20-day, and then there was a bit of a rebound, but not by very much. The adjusted close left us at about 22,488. The 20-day is just under it at 22,474. So naturally, I mean, that's the first number. It'll be nice if the market kind of respects that, and we don't see a break or a break and further slide below. Hourly RSI, relative strength index, very simple, but it's useful. Hourly RSIs are now suggesting that the market is oversold in the short term. You can look at the daily swing levels, etc. as well. You're getting to a position where things are oversold. Now, a 61.8% retracement for the sort of move that we've seen is 22,313. That's the next support in case the 20-day really goes. So 22,300 is the next broad support level. Bank Nifty was the only saving grace yesterday. I mean, actually, we ended about 0.75% higher there. And we've finally retraced the 61.8% of the entire fall that we saw. On the Nifty Bank, yesterday's low, which is 48,380, should not break on the downside. And the 40-day exponential moving average is 48,139 below that. So, these are numbers. On the upside, of course, on both the Nifty and the Bank Nifty, we know the recent highs, we know the all-time highs. So that is something which I think we are pretty okay with. It's just that the market has been weak. We've kind of retraced 50% of the move that we've seen from the recent low to the new all-time high, at least on the Nifty. And we are in a bit of a tentative holding pattern kind of position. Election results will be the market is in a bit of a make or break zone. And I think we'll only get that sort of real move once the numbers are out of the way. GIFT Nifty on your screen. It should come up, give you a sense of how we're likely to start. It's up about 50 odd points or so. Sonia.
Okay, so the implied opening is suggesting a big green start, right? You get a sense from all the data around you that this market is perhaps positioned for a big move on the upside post the election verdict and once the election results are out of the way, and if it is favorable in terms of policy continuity and policy stability, something that the market wants. So putting all of that into context, today could be a really big day where market positions itself for perhaps a big move on the upside. But let's see. For now, the cues are not that good. So the global cues are, a bit under pressure. The Dow is down over 300 points overnight. The Nasdaq was down about 1%. The Nifty, remember, is down for 5 straight days now. And from the peak that we saw in the month of May, the Nifty is now down 600 points. But there is definitely a lot of buying interest, and you've seen that with the domestic institutional investors as well. DI has bought 3,400 crores in the cash markets yesterday, and there are plenty of stocks in focus. So now, of course, it's the end of result season. But we do have some stocks that we're looking at this morning, whether it is names like Muthoot Finance, where the numbers have been pretty good, AUM growth of 20%, and these gold-focused companies have been doing well. It was a strong Q4 for Bharat Dynamics as well, a strong operational performance rather. The top-line growth was in single digits, but the EBITDA growth was about 73%. But let's come back to the bigger picture, because there are a couple of things that you need to watch out for. One is the Q4 GDP data for India that comes out later today, and the second is auto sales for the month of May that gets reported tomorrow. Now, this is important because it is a barometer of sentiment and demand trends. The auto sales for a couple of pockets will look good. Two-wheelers will continue to shine. So watch out for names like Bajaj Auto, Hero MotoCorp, double-digit growth expected there. The other stock I'm looking at is Ashok Leyland, because that has been climbing quite steadily, and the sales growth is expected to pick up this time, about 12% year on year. So it may build on to its gains that it's seen in the last couple of months. So these are a couple of stocks I'm looking at, but very, very interesting times for the market, because if the verdict goes in favor of what the market wants, then we could be staring at a big upside in the market in the next couple of days. Is that what the market is positioned for? Seems to be the case, but time will tell.
Well, on a lighter note, NVIDIA overnight, a bit of a rarity, it was down closer on 4%. So maybe some of that liquidity is available today to be deployed. Because it's very, very rare that you see NVIDIA down 3 to 4%, and that's sort of a base close to around $3 trillion in terms of market cap. Well, let's stack up the big cues, though, over the weekend first. It's going to be a very, very big weekend, mind you. And in fact, we have plenty of cues that are coming in there. Later this evening, you'll have the PCE data that comes out from the United States. So that's a parameter of inflation that the Fed tracks very closely. Over the weekend, you have the OPEC meet as well. You'll get the outcome over there. So Brent crude will be important. And also you have the exit polls that come over the weekend. So it's a very, very big week in terms of cues for the markets. Now let's come to the data points. We're starting a new series. And if you look at the market-wide position, or even if you look at the Nifty positioning, in terms of open interest, it's much higher if you compare it with the previous month itself. So much higher in comparison to the start of the May series. What about the FIs? Well, they are starting this series net short. So close to around, we have aggressive net short out there in terms of the FIs. You have close to around 87% of their positions on the short side. In absolute terms, it's close to around 3 lakh contracts approximately. So that's the important number out there. But if you look at it, the last time that they were so aggressively net short, well, you had a big bounce. April 2023, November 2023, when they were close to around 89 to 90% odd. In both those two series, you had a big bounce. This time around as well, it's at around 87%. So we are bracing for a big bounce this time around as well, which is going to be very, very important. So we'll have to keep an eye at whether or not the FIs get trapped on the short side yet again. But, countering their short positions are the domestic participants. Large HNIs, retail, they are aggressively net long this time around. Just take a look at the long positions on index futures. Take a look at the long positions on stock futures. So the net positioning is much higher. You have a strong counter that's coming in there. And we have seen in the past that the domestic participants, well, they have normally got it right. So let's see whether or not this time around as well, it's the same case. Levels that we're looking at, we're close to the 20-day MA, reference points on the downside up here. And also the Nifty Bank. Yesterday, we saw a bit of a relief rally. Remember, the rollovers were on the lower side that we saw post-Wednesday's close. Those reference points as well, the Nifty Bank comes up for you on the screen. 20 as well as 50-day MA. So we're bracing ourselves for a big move. I think that negative view on the Nifty will only come up if we breach the 21,800 or the 22,000 odd mark. But otherwise, you'll have to back the bulls and say we're bracing for a bit of a pullback.
Okay, exciting times ahead for the market as the market reacts to the election verdict on the 4th of June. And, of course, reacts to the exit polls on Saturday night. So, interesting weekend up ahead as well for everyone who's tracking the markets, right? But let's do one thing. Let us take you through some opinion now. Sanjeev Prasad of Kotak Institutional Equities says that the Indian market continues to be a mix of optimism and euphoria, with parts of the market rightfully reflecting the strength of the Indian economy and its long-term growth prospects, and other parts reflecting extreme euphoria linked to baseless narratives with absolutely no linkage to fundamentals. He says Q4 FY24 results did little to change the trend in sectors or views on the market.
We have V. Lakshmanan, a federal bank, who weighs in. He says that Asian currencies weakened during the week due to rise in US yields above 4.6% levels and shrinking bets of a Fed rate cut in September. He says the rupee fell almost 40 paisa after making a high of 83.03 last week. The dollar index, after hitting a two-week high of 105.18, is now seeing a quick fall after GDP growth for the quarter fell. He expects the rupee volatility to continue owing to election results. Coming sessions could see the pair, that's USD INR, between 82.75 to 83.75.
Okay, and on the bonds, Lakshmanan says the government bond yields traded lower after the RBI announced a record dividend transfer of $2.1 trillion to the central government, thereby giving a positive boost to the government's fiscal position. He says buyback auctions and lower T-bill supply further supported bond prices. He adds markets now await results of the country's general elections due next week, and US yields inched higher after economic data there seems to suggest that business activity has picked up and the labour market remains tight. He says coming sessions could see the 10-year benchmark bond yield in a range of 6.95 to 7.05%.
Well, we've got a lot of stock-specific action track for you. We get that in just a bit in our special Top 10 segment. We're looking at Apollo Hospitals, Muthoot Finance, Para Dynamics, Geo Financial, Suntech Realty, and Mrs. Vectors. All of them will be reacting to positive news flow. On the flip side, Welspun Corp, Paytm, Swan Energy, Yatra Online, all of them will be reacting to negative news flow.
All right, James Knightley is Chief International Economist at ING. He's joining us right now. James, good morning. Good to have you with us here. Thanks very much. So there are two big talking points today. There is, of course, the elections here in India, which we will get at least a glimpse of directionally, because exit polls are tomorrow. And they'll give us a sense of which way polls essentially have captured how voters have gone, which way voters have gone. And the second one, of course, is this news from overnight, where there is a conviction for former US President Donald Trump. I want to start with the second one, which is the Trump conviction. Just your thoughts, James, on this one. Sentencing, of course, is there'll be an appeal, I'm assuming. But do you think there'll be more of these cases before the November election, or you think this is it? Your sense?
Well, I mean, there are more cases in the pipeline. It's just whether they will get heard in time. We are not that far away, really. And of course, with the sentencing coming up, that's going to take priority. But in general, I guess the key story is: does this impact the prospect of Donald Trump's re-election campaign? And it's really very early to say. But there have been various surveys done here in the United States, and one of those was by CBS, for example, and they suggested that 15% of Republican voters would perhaps have another think as to whether Trump is the right candidate if he is indeed convicted. So we'll be looking really to see if that does start to weigh on his popularity in the opinion polls, and whether we start to see Joe Biden start to push ahead once more in those presidential election campaigns. I mean, that is going to be a big story for next year, because there are some clear differences between Donald Trump's main economic messaging and Joe Biden's main economic messaging. I think there are four key stories really here. One, of course, is taxes. Tax cuts are wanted by Donald Trump, not wanted by Joe Biden. We've got tariffs that Donald Trump wants to really accelerate and spread out across the world on imports into the United States. Thirdly, of course, he's got controlling of immigration. He wants to really restrict that. And then fourthly, we've got geopolitics as well. Trump is going to solve Ukraine and Russia in a day. So there's some really marked differences. So this could have some quite profound impacts on financial markets as we head towards that November election.
We have a big election happening in India as well. One where the incumbent government, in all likelihood, could come back into power. And perhaps that's something that the street would like as well, given continuity of policy action. How are you feeling about India now, given the economic context?
Well, I mean, as you say, continuity is normally the market's friend, and that is what the market is anticipating once more. I think in a global context, we are seeing quite a lot of election risk this year, and not everyone is going to get re-elected around the world. So we are looking at some changes, perhaps not in India, but we certainly are seeing that prospect for change as a strong possibility here in the United States. And I think that global backdrop is going to really be the fundamental story behind where overall market direction is likely to head.
Hi, James. Morning. Nigel on this side, and good to see you. When, James, a couple of months back, you were in minority, actually, when you said that the Fed will be looking to cut only in September. And that seems to be the base case as of now. So you were spot on that front. What do you expect the Fed to do in terms of rate cuts for this calendar year itself? And what about 2025, if you could give us the trajectory? And expectations
Sure.
from the PCE data as well later today.
Yeah, I mean, the market's pricing for Federal Reserve rate cuts has shifted dramatically this year. In early January, we had nearly 7 25 basis point rate cuts priced. Now we've only got one and a bit, really. We still think there's a chance that the Fed does do more. And part of that is down to the inflation backdrop. I think for that September rate cuts that we're anticipating, we need to see three things. And one of those could happen tomorrow with that core PCE deflator. I think, in terms of that core PCE number, we've got 5 months, really, 4.5, 5 months until we get that September policy meeting. I think we need to see at least 3 0.2 month-on-month core inflation prints. We've been averaging 0.3. That's still too hot. We need to see 0.2s coming through, and hopefully we will see one of those tomorrow. Secondly, I think we need to see some evidence of consumer spending softening. The retail sales numbers lately have been a little bit disappointing, and the evidence from various surveys have also pointed to a bit of a cooling coming through. So if we see more evidence of that, my confidence in a September rate cut will be increased. But thirdly, of course, we've got to remember that the Federal Reserve has two targets. It's got a target for inflation, but also it's targeting maximum employment. And if we see the unemployment rate start to tick even further higher, remember we've got the jobs report next week, that could be another catalyst for the Fed to cut. We've gone from 3.4 to 3.9% on the unemployment rates. If we break above 4, say get towards 4.2%, I think that slack, if you like, in the labour market would give the Fed the confidence that it can cut. So those three things, we're looking for a 0.2. Hopefully we'll get one of those tomorrow for core inflation. We're looking for that cooling of consumer spending, but also importantly, we're looking for that jobs market cooling as well, with the unemployment rate probably pushing above 4%. And that, I think, could be the trigger that delivers that September rate cut.
Okay, we'll let you go on that note. Thank you so much for joining us and giving us your quick take on both international as well as the domestic economic trends. Thanks for that. Let's slip into a quick break. We have lots of stocks lined up in just minutes from now, so don't go anywhere. We'll be back in some. Welcome back. As we said, plenty of stocks to talk about. So without wasting any time, let's go straight to our research team to get you that list. Vivek is joining in first up to talk about Apollo Hospitals and why you should be watching that one. Vivek, good morning.
Well, good morning. Results came last evening. Appears to be a good set as far as Apollo Hospitals are concerned, especially when you're comparing it to our own estimates. Q4 FY24 revenues higher by 15% on a year-on-year basis, coming in at the 4,943 crore mark. Our estimate was closer to 4,880 crore mark. When you're talking about the margins coming in at 13%. Our estimate was close to 12.7%. Profitability coming in at 258 crore. Our estimate was largely in line, close to 250 crore. Now, talking about the key metrics to keep track of, the average revenue per occupied bed has improved 5% on a sequential basis and has gone up by 12% on a year-on-year basis, coming in around the 59,523 rupees. Now, talking about the healthcare GMV, Apollo Hospitals had earlier given a guidance of achieving a GMV of close to 28 to 2,900 crore. However, what's actually transpired as far as FY24 is concerned is slightly muted, 2,687 crore. So that appears to be the only blip as far as Apollo is concerned in an otherwise strong operational performance.
All right, Vivek, thanks for that. And do remember, we'll be connecting with the management of Apollo Hospitals at 9:40 a.m. later today. Well, let's focus on a couple of other numbers. Abhishek joins us to tell us about Muthoot Finance. Abhishek?
Well, Muthoot Finance, it looks like they made hay while the sun has actually shone on them. So there are two key aspects which actually work for them in this quarter. The gold prices, which have increased by more than 6% quarter on quarter, and competition which has come down due to IFL Finance. They have taken that market as well. So AM growth is about 20% YOY and 6.5% sequentially. In that, the gold AM growth sequentially is about 5.3%. Asset quality has improved. Gross NPA ratio has declined sequentially. Net interest margin has expanded to 11.62% versus 10.88% in the previous quarter. So the operating profit growth is really strong at 16.9% YOY and about 8.3% sequentially. Even in their subsidiaries, that is the Home Finance, AM growth is about 41.5% YOY and about 14% sequentially. The Bellstar MFI, that AM growth is also strong at 62% YOY and more than 13% sequentially. So they have beaten our poll with respect to Anna and Pat as well. Back to you.
All right, Abhishek, thanks very much for that. That's Muthoot Finance, and more on this one as we go along. Bharat Dynamics is a company, a stock which is, of course, has done so well. Upasana is here with the numbers on this one. Upasana, morning.
Companies reported a strong set of numbers in Q4 FY24. Looking at the revenue growth, while it was single-digit revenue growth of 7% on a YoY basis, but PAT and EBITDA saw a sharp expansion. The PAT was up by almost 89% on a YoY basis and EBITDA was up by 75% on a YoY basis. Well, reduction in finance cost and higher other income growth has aided the PAT growth overall. Now, coming to companies' EBITDA margins, they have expanded sharply from 23% to 37% on a YoY basis. Now, looking at companies' overall FY24 performance, the revenue saw a downtick of 5% on a YoY basis. Well, this reduction in turnover is mainly on account of the geopolitical situation prevailing in Europe and Middle East, impacting the supply chain of the company, is what the company has indicated. Coming to margins of the company, they were expanded sharply on a full year basis from 16.5% to 22.8%. PAT has also seen an uptick of 74% on a YoY basis, and looking at the order book, it stands strong at 19,468 crores. So all in all, we are seeing a strong set of numbers coming in from.
All right, thanks a lot for that. That's Bharat Dynamics in focus today. But let's hop across to Abhishek. He's going to talk about Paytm and Jio Finance. Abhishek, over to you.
Well, Jio Finance over there, they have launched a Jio Finance app in a beta version. This will integrate the digital banking as well as UPI transaction, bill settlements and insurance advisory as well. They'll offer a consolidated view of your accounts as well as savings. It's designed for a frictionless navigation, and its future plan includes, expanding into loan solution wherein they'll start with loans on mutual funds and progress towards home loans. Back to you.
All right. Thanks a lot for that, Abhishek. Well, I'm looking at a couple of other names. Welspun Corp, that's a stock on my radar. The operating profit actually was lower. It was down by close to around 21% odd, telling you that there were some signs of pressure. And that's why the margins, if you look at it in the past quarter, compare it on a sequential basis, compare it on a year-on-year basis as well, it's a little bit lower. Two factors played out. One is the employee cost was much higher. The second factor is that the gross margins did see some compression. But you'll see that the net profit was much better. Why is that? Because the other income was higher, the finance cost was lower, and the performance of their subsidiary in Saudi Arabia, well, that was fairly good. And that is an associate company. So that explains why below the operating profit, in fact, the net profit looked quite good. But they've gone ahead, they have reduced their debt drastically, and they put out their guidance as well for the coming year, 17,000 crores of revenue, 1,700 crores of EBITDA. These numbers go down as a bit disappointing. We'll have the management later in the day, so we'll try to clarify why these numbers were a bit of a miss.
All right, Nigel, thanks very much for that. Well, Suntec Realty and Swan Energy are the next two companies we are focused on. Sonal is here with details on these two. Sonal, morning.
Good morning, Prashant. Let me start with Suntec Realty. It was a decent set, but if we look at the YOY performance on an operational basis, their pre-sales were up 26%, but collections declined by 32% on a YOY basis. But FY24, they ended with the highest ever pre-sales number at 1,915 crore rupees. Additionally, the board has passed an enabling resolution to raise funds up to 2,250 crore rupees, which will be a mix of QIP, debt raise, preferential issue, ADR or FPO as well. Swan Energy, well, the numbers looked weak when it comes to the operational performance. Revenues were up by 50%, but EBITDA declined 51%. Margins declined to 8.4% versus 25.5%, and profits were down by 10.5% as well. Remember, it is into diversified business, real estate, oil and gas, LNG, and is also making headways into the port business. So this is one stock to watch out for. Okay, thanks a lot for that. So that is Suntec Realty and Swan Energy. Mangalam is with us to talk about Mrs. Bectors and Yatra. Mangalam, how is it looking?
Well, good performance coming in from Mrs. Bectors, and that's something that has continued over the last many quarters, and that's why the stock has also doubled from the lows itself. 17.5% revenue growth that the company has reported, led by both their biscuit and bakery segment revenues up nearly 18%. Gross margins improved for them as well, and as a result of which the EBITDA is up 21.5% and the net profit too has grown about 20%. The big trigger for them, of course, over the last many quarters has been them increasing their reach and the retail footprint that the company has been growing, and as a result of which that's reflected in their growth. Can't say the same for Yatra though, because despite travel passengers and travel volume increasing a lot, that hasn't reflected in their revenues. That's largely because of a couple of one-offs and the fact that this is a seasonally weak quarter for corporate travel itself. So their revenues have been lower by about 10% year on year. The EBITDA has actually all but eroded at 80% decline, and the net profit too has come in lower by about 38%. Now you'd wonder, why is it that the EBITDA has fallen 80% and the net profit just 38%? Because there's also an element of other income which has actually increased from 3.5 crores to 11.3 crores. The company said the revenue is lower due to a one-time accrual of threshold of bonus in their global distribution system. If you adjust for that, the revenue growth is actually 7%. They've added 25 new corporate clients, and corporate travel is now, despite the weakness in IT sector, back to pre-COVID levels. So expect Yatra to open in the red. Thereafter, let's see whether it sees recovery or not.
Okay, thanks a lot for that. Here's a quick recap of our top stocks. Stocks with positive news flow: Apollo Hospitals, Muthoot Finance, Bharat Dynamics, Geo Financial, Suntec Realty and Mrs. Bectors. While stocks with negative news flow: Welspun Corp, Paytm, Swan Energy and Yatra. But the MSCI has also announced a list of additions, deletions as part of the May index review. The adjustments come into effect today. Vivek joins in to give us a recap of all the changes in the MSCI Global Standard Index and the MSCI India Small Cap Index. Vivek, over to you.
Well, good morning. Today at least you will see some amount of FI flows, given the fact that passive funds will be forced to go ahead and buy, especially in the last hour of the trading session. So now what actually happens after today is that India's weightage in the MSCI Emerging Market Index goes to a historically high level of 18.8%, second only to China. Now today India will see net cumulative inflows of a little over $2 billion, almost $2.5 billion to be more precise, in today's rejig. As far as the MSCI Global Standard Index, the index which has a lot more liquidity and is more well tracked, there are 13 additions and 3 deletions. We'll quickly go through the list of 13 additions. Bosch, Canara Bank, Indus Towers, Jindal Stainless, JSW Energy, Mankind Pharma, NHPC, PB Fintech. PB Fintech will see flows of almost $232 million today. All of these estimates are from IFL Alternate Research. Phoenix Mills, Solar Industries, Sundaram Finance, Thermax as well as Torrent Power are the stocks that will be added to the index, while there are 3 stocks that are being deleted: Berger Paints, Indraprastha Gas as well as Paytm, that is 197 Communication. Now as far as the MSCI India Small Cap Index is concerned, 28 additions and 14 deletions is what will happen. So especially in the last hour of the trading session, expect heightened volume activity. One thing to note, these changes were declared on May 14th, and a lot of active funds have probably already taken a position. So expect don't expect too much of stock price reaction. However, volume activity over here will be heightened.
All right. Vivek, thank you very much for that. A lot of pre-positioning, etc., as Vivek explained, does take place, and a lot of action, of course, later towards the end, last 30-odd minutes of trade today. Vivek, thanks very much for that. We take a break. We are back with Siddharth Khemka, Head of Retail Research at Motilal Oswal Financial Services. We'll talk individual stocks and sectors with him. Stay with us.
Welcome back. Hope you're having a good morning. It's a big weekend that's coming up. For starters, the GIFT Nifty is suggesting that we're likely to open up with a gain of close to around 50 points or thereabouts. So important to build on from there. But plenty of stock to discuss. Siddharth Khemka, the Head Retail Research at Motilal Oswal Financial Services, joins us on the show. Hi, Sid. Good morning and good to see you. And, just scrolling through. And in fact, the election is so big this time around. A couple of cinema halls, they're screening it as well. So that's the kind of excitement ahead of this verdict. But let's discuss a couple of stocks then, Sid. Yesterday, the biggest loser was Tata Steel. What the street seems to not be liking is that the debt will continue to remain at elevated levels because in India, they are doing some capex. And the problem is maybe some good money is chasing the bad money. That is with regard, to the UK asset. So that's why I think a little bit skittish. What's your view? The stock was down close to 6% in yesterday's trade, closer to around 165 rupees.
Nigel, good morning. Good to be on the show. So if you look at Tata Steel numbers, I think the numbers on their own were two parts. A, better than expectations, but on their own, still a bit weak. The good part, at least on some accounts, was the guidance that the next 2 quarters could see improvement in volumes as well as realizations and costs, especially on the cooking coal side, which is kind of coming down and leading to improvement in the margin. So overall, I think the India business has posted a decent performance. Domestic demand momentum is expected to continue. And the Tata Europe operations has seen a sharp reduction in the losses. And what the company has guided is that it expects the European operations, the Netherlands operations, to start reporting a positive EBITDA from Q1 and the UK to report positive EBITDA from Q3 of FY25, which is a big change that will happen in FY25. So I think that is something which is positive take on from the results. The company is also on track to increase its steel capacity to 40 MT which is again kind of positive given that improving demand scenario. What is happening is that I think, yes, debt is something that is still bothering the market. The fundraise is again kind of taken a bit negative. And again, the valuations, I think the current price, the stock is trading at more than 7 times EV/EBITDA. And we believe that it is adequately priced because the improvements are not such strong to further improve or increase the valuations from here on. So we kind of have a neutral rating on Tata Steel with a target of 160.
Okay, neutral rating on Tata Steel with a target of 160. Got that. Siddharth, hi, good morning, and thanks for joining in. You know, the auto sales for the month of May are going to be coming out, are going to be released tomorrow, right, on the 1st of June. We have a lot of stocks in focus, of course, but the one I want to ask you about is Ashok Leyland, because the company post its numbers, posted last month's sales, has been seeing a recovery in commercial vehicle sales. The management commentary is very positive, and the expectation is that there will be double-digit growth in numbers this time. Is the risk-reward favorable for a stock like Ashok Leyland?
I think, yes, within the auto pack, if you look at something like an Ashok Leyland, the risk-reward definitely is favorable. While on the overall monthly volumes, that the numbers that will come up from next week, we are not expecting a very strong number. Numbers are expected to remain soft, especially if you look at from the CV side. The MHCV numbers and the LCVs are expected to decline about. So MHCVs should decline about 8 to 10%. LCV, we are expecting a decline of about 2 to 3%. And if you look at the key segments, the iron ore, cement sector, infrastructure have led to a slower growth in the CV segment. However, we believe that post the elections, we would see again improvement in the activity in both in infrastructure, in a lot of these other activities, which should improve demand for CVs. Also, we are witnessing that monsoon is likely to be pretty good, and that should also lead to improvement in demand for sectors like tractors and two-wheelers. And within the overall auto pack, as I said, two-wheelers, Hero Moto is something that we like, where the risk reward is much favorable. The stock is trading at a significant discount to Bajaj Auto. Similarly, for Ashok Leyland, the valuations are much comfortable compared to a Tata Motors, and growth in the core business plus the several EVs launches that they have done, that should also lead to a good demand growth in the overall numbers. So we definitely have a positive view on Ashok Leyland. We have a target price of 240 and a buy rating.
You know, banks, Sid, hi, morning, Prashant here. Banks were the saving grace in that sense, right? I mean, the market would have been down easy 300 if banks were also down yesterday. But the top 4-5 banks were all up, varying degrees, but nothing very large. Do you think post the sort of election results, because maybe you know, they're not done anything at all, large private banks for a while, valuations are reasonable as compared to other sectors, you know, action may coalesce around this pack? What's your sense?
Yeah, Prashant, I think, yes, if you look at the overall quarterly season as well, banks, the earnings growth from private banks have remained healthy. Advances growth has been in the range of 3 to 5% on a sequential basis for most banks, and this has been fueled by growth across retail and MSME segments. We have seen a big focus on the deposits, and hence banks are paying more attention to the liabilities, and consequently the deposit growth is expected to be a little more see improvement, and CASA mix also improving for FY25. Asset quality continues to remain healthy. Within that, some of the PSU banks, especially SBI, which has come out with very strong numbers, and compared to some of the other smaller PSU banks where the guidance is kind of a little bit muted. So I think within the overall banking space, ICICI, Axis, and SBI, these would be our 3 preferred picks. If you look at even SBI, we have a target price of 925, and we expect a healthy credit growth of about 13 to 15% for SBI, which is a leader in the pack. Valuations continues to remain comfortable, and that is something which could support the market going forward.
Just stay on, so that will come to you. There are plenty of brokerages that have come out with some notes this morning, and Sudarshan, my colleague, has glanced through all of them. Sudarshan, over to you. What stands out today?
Morning, Sonia. So in today's brokerage corner, I'll start with Cummins, which had seen a sharp reaction after its con call and had closed yesterday's session with a cut of almost 6%. But brokerages, though, remain positive on the stock. Macquarie has an outperform call with a target of rupees 3,975 per share. It says underlying was less healthy than headline, but still healthy. And in the medium term, it sees distribution, business growth and data centers to help margin. But in near term, key monitorable is impact of full-fledged transition to CPCB 4+. Citi also maintains buy call and raises target to 4,384 from rupees 3,519 per share. It says company is well positioned to cater to traditional and emerging growth markets. Nomura, though, has a neutral call and target is rupees 3,470 per share. It is cautiously optimistic on margin sustainability, but it has raised FY25-26 EPS estimates by 2% to 4%, but it's neutral on expensive valuations. Now shifting to one of the stocks which is like most tracked by retail investors, that is Zomato. Macquarie has an underperform call and target is rupees 96 per share because it says competitive intensity is rising and JioMart will start delivering groceries in 30 minutes from next month, and it will initially provide these services in 8 cities and expand to top 20 to 3 cities in phase 1. It continues to see downside to consensus forecasts and margin for Blinkit. Last is MS on Prestige States. It has an overweight call and target is raised to 1,770 per share. It says company has raised, it has raised target on a strong pre-sales outlook for FY25, and this strong outlook for FY25 is on a high base of FY24 and it is driven by strong launch pipeline and ready inventory. But concerns are high gearing and low margin. So these stocks we need to track from today's brokerage corner.
Okay, thanks a lot for that, Sudarshan. That's a very exhaustive list of all the brokerages that have written for trade today. So keep an eye out on that. But moving on to the big global story, the jury makes history in New York by convicting former US president for a crime for the first time. Donald Trump has been found guilty on all 34 counts in hush money trial. NBC's Alice Barr joins in with the details.
We've seen reaction pouring in already to this guilty verdict against former President Trump. This is something that has been highly anticipated, and it comes on 2 tracks because there's the legal outcome and then there is the vast political reverberation, of course, from that decision. 34 felony convictions now for former President Trump in this hush money scheme in New York. And that is where the decision came down in that courtroom, but it has effects on Capitol Hill behind me here. It has effects on the campaign trail. And former President Trump really seemed to have his eyes on the upcoming election from the moment that he walked out of the courtroom. So let's let you hear some of what he said right after his guilty verdict.
This was a rigged, disgraceful trial, but the real verdict is going to be November 5th by the people. And they know what happened here, and everybody knows what happened here. We have a country that's in big trouble, but this was a rigged decision right from day one with a conflicted judge who should have never been allowed to try this case, never. And we will fight for our Constitution. This is long from over.
He's saying this is far from over, and we can certainly anticipate there are going to be appeals from the Trump legal team. That is going to be a lengthy process that could play out really over years, the appeal process. What happens directly next from here is the former president's sentencing date is set for July 11th. That is just 4 days before the Republican National Convention will take place, and that's when he's set to be formally nominated as the next Republican nominee for president. Important to note that even though he has now been criminally convicted, he can still run for president. He can still hold office as president. He could potentially be sentenced to up to 4 years in jail, but more likely the judge would go for more of a probation route. He's been relatively conservative throughout the trial in terms of he could have put the former president in jail for violating a gag order, being held in contempt of court, and he said clearly, the judge said from the bench that he didn't want to do that. So that may offer some clues about where this sentencing could go. But there's no question that prosecutors are feeling good that they managed to get a conviction in this case. It's very likely that this could be the only one of the 4 criminal cases against the former president that will be resolved before the election. And let's let you hear from the Manhattan District Attorney about his response directly after the conviction.
While this defendant may be unlike any other in American history, we arrived at this trial and ultimately today at this verdict in the same manner as every other case that comes through the courtroom doors, by following the facts and the law and doing so without fear or favor.
So once again, that is the legal result that we saw today. The much bigger question, what follows on the political front? Back to you.
All right, so that's a nice piece outlining what's happening there. So political temperatures in the US also heating up. You know, I just want to point out one thing. There was an ABC News poll, which was done fairly recently, and they asked that Trump supporters whether they will decide to vote for Biden or somebody else if Trump were to be convicted. Of course, this was before the conviction. Only 4% of the supporters said that they would withdraw support. So it's a very loyal support base. Towards Trump. So, you know, it's not, it's, and that's what matters in that sense, right? And of course, this will be appealed and most likely, I mean, this won't affect his chances in terms of fighting the election itself. And if you go by this data, we don't, if this can change, but largely people will be unmoved because of the conviction. That's what the poll says.
And the political landscape has changed a lot in the US after what happened with Israel and Palestine as well, right?
Yeah.
The war has sort of...
although it remains to be
disparate,
it remains to be seen if it's going to have a sort of impact when people go out and vote. But yeah, absolutely, we've seen a fair bit of demonstrations, especially around campuses, young people coming out, etc.
You know, just a point with regard to the stock market. Besides all of that, post the U.S. election, 5 out of 6 times the IT index has rallied. You know, so let's see whether or not FY25 could be the final year of pain. We'll have to wait and watch. DAM Capital, in fact, had put out a note on these lines that they believe FY25 will be the final leg of pain, and from FY26 onwards, we see a recovery out there, and they see history supports that. So that's the reason they made that point.
Okay, but we also have history that, you know, may play out right in the next few days. I mean, it's a big election verdict, and let's see which way things go. Anuj is joining in now for, you know, view on how trade is set up. Anuj, very interesting, right? Because the market has fallen, what, 600 points in the, from the peak that we saw in the month of May. Are we positioned for a big move post the election verdict? Is that the sense that you're getting?
Morning, Sonia. Well, you know what, if the BJP falls short of the number, then 600 points is nothing. But if the BJP actually wins, then yes, you know, you get back plus more in terms of what you lost. But you know, the big point this morning as we start trade is the record shorting by FIIs, nearly 3 lakh contract short. If you adjust for the lot size change, that's the second highest shorting that we have seen. Even in percentage terms, we are at 13%. The lowest ever was 11%. Now, you know what? The last 3 times FIIs have shorted so much, the Nifty has rallied 1,000 point plus. So the obvious question is that, will the history repeat itself, or is this time it's different? That's a term that you hear a lot in stock market. I just want to make another point. If you look at the Nifty versus Bank Nifty, it also tells you one more thing. While we are too preoccupied with what's happening in terms of our elections, don't lose sight of what's happening in the US, because that's also something important. This week, Nifty is down 2%. The Bank Nifty is down only 0.6%. So it's hardly corrected. And Nifty IT is actually down almost 3%. So Nifty has seen aggressive short rollover. The Bank Nifty has actually seen long rollover. So there is some bit of buying in the Bank Nifty compared to selling in the Nifty. And as I said, Nifty IT is down 3% and broken 200-day moving average decisively. So the market's nervous here, obviously, about the election, but also what's happening with the US bond yield and what's happening in the US over there. Now coming to the levels, it's very interesting. When we start the series or the monthly or the weekly contract, we look at that week's options. But look at the monthly options, the 24,000 call and the 20,000 put. They are trading with really high pricing. That's the impact of the VIX. Are you saying that the Nifty could go above 24,000 or below 20,000 in this series? Probably not. But then, the markets normally get so nervous ahead of elections that is how some of these options get priced. Extremely expensive options because of this event and India VIX. In terms of support, 22,394, that's the 50-day exponential moving average, and then 22,200, that's chart-based, and the resistance comes in at 22,570 to 22,600, the 20-day exponential moving average, and then 22,700 to 22,750. The Bank Nifty is stronger of the two indexes, but still, in terms of levels to watch, I'll keep a range of 48,300 to about 49,000 thereabout. We close right in the middle of that range. And as always, I leave you with quote of the day. And this one is interesting. It's a very short one, but I think makes a lot of sense. The dream is free. The hustle is sold separately.
Okay, the hustle is real, right? Anuj, thanks a lot for that. Very important, both market and life lessons. But thank you and have a good day. Well, that's the word on the market and what you should expect. But let's do one thing. Let us take a quick commercial break. On the other side, Shrikant Chauhan of Kotak and Vinay Rajani of HDFC Securities will join in for some trading strategies.
Okay, welcome back. There's 8 minutes to go for the pre-open session, and it's going to be an interesting one once again. Although the market's been drifting lower and lower and lower, and we are at the 20-day moving average in the Nifty, RSI, etc. At least on the hourly is looking a little oversold. So what now is the question? Shrikant Chauhan of Kotak is with us on Friday mornings as always, and Vinay Rajani of HDFC Securities is also with us. Gentlemen, good to have both of you here. Thank you very much for your time. Prashant this side. Shrikant, Anuj was talking about the hustle. What's the hustle today? What's the setup today, and how would you trade it for our viewers?
Yeah. Good morning, Prashant. Good morning, everyone. I think, the markets are correcting to the its previous rally that we saw from the levels of 21,800 to almost 23,100. No doubt that the current correction is more than the expectations. I was expecting market to find somewhere support somewhere close to 22,500, 600 levels. But because of the monthly expiry and the overall global macros, we saw some more weakness in the market. We could see further more weakness if there is any further more deterioration in the global macros. But broadly, we are of the view that the current sell-off is nothing but a corrective pattern. And at current levels, the market is having support of 20 days simple moving average, which is around 22,450, 475, and 50 days is placed at 22,400 levels. In this particular upward activity, whenever the market has corrected, it has taken support of 100 days simple moving average, which is around 22,200. So in the worst case scenario, we could see the levels of 22,200. But otherwise, I'm of the view that it is going to rebound and again going to retest the most challenging level of 22,800. So I am of the view that we should look for creating some long positions in today's date with a stop loss at 22,400. And for the Bank Nifty, there also we are expecting similar sort of activity, but 49,000 is the level above which we could see a major short covering in the market. So 49,000 is going to act as trend deciding level.
Okay, so all right. So that's on the market, right? Vinay Rajani is also joining in. He's of HDFC Securities. Vinay, hi, good morning. What is your best sense of how the wind is blowing right now? And what's the best way to approach it?
See, technically, if we speak, overall, the higher tops and higher bottoms are still intact on Nifty and Bank Nifty chart. And if you were to look at the last 5 days correction, Nifty has retraced 50% of the entire rise, which we saw from the low of 21,800 to 23,100. So it's just, as of now, we can say that it's just a retracement of the entire rally and the entire bull run, which we saw previously. And 61.8% retracement comes in around 22,300. So technical theory says that as and when some underlying retraces 61.8% and bounces back, then there could be a resumption of an uptrend. And if it is not able to hold that level, it is breaking and violating that level, then the entire rally gets negated. So we have to closely watch whether we are sustaining about 22,300 or not. 50 days exponential moving average is placed around 22,380 odd levels. So there are multiple supports in the range of 22,300 to 20,380. We need to track that level closely and we need to track it on the closing basis. So according to me, 61.8%, the golden ratio, Fibonacci golden ratio gives a strong support, and I am hopeful that the whatever fall we have seen, whatever correction we have seen, ultimately could turn out to be a temporary and short-lived, and ultimately market could resume the uptrend. And if you were to go by the data of FIs, they have turned net sellers, and almost 88% of their positions are on the short side. So if any surprise comes on the positive side, there could be a sharp short covering in the large cap stocks and FNO stocks. That's what can happen. So we have digested the shorts of FIs in last 5 days, 700-point correction in the Nifty. But still, I am hopeful because higher top, higher bottom is still intact, and anytime soon we can see some reversal also. So 22 to 1,300, the level which I am tracking. Decisive close below that definitely will change the things for the markets. But as of now, I am hoping the markets could again bounce back and resume the uptrend.
Okay, what about individual stocks? Shrikant, let me start with you. What's on your list today?
Yeah, I would like to go with Ashok Leyland, which is currently around 220, 219. If we see the pattern of last few days and weeks, the stock is gaining extra momentum. At the same time, there is rise in the volume and delivery-based volume. So while looking at the entire setup of the stock, I am of the view that it is heading for at least 250, 260 sort of levels. But in the near term, we could see the levels of at least 235. It's a buy at current level with a stop loss close to 214. And the other stock which we like is from the BFSI space, and that is State Bank of India. It is consistently holding above the levels of 815, 820, which is positive. And the next level to watch out for would be 855, 860. I feel and I believe that it is like very close to, I'm going to say, based on technical pattern, it could reach these levels very easily. So at current level, it's a buy with a stop loss close to 815.
Okay, all right. Thanks for that, Shrikant. Vinay, what about you? Individual stocks, what's your recommendations?
So I would recommend one long and one short. So Bajaj Finance in yesterday's session saw a trend line breakdown on the daily chart with a higher volume. So it has been underperforming in the large cap space, and yesterday we saw a clear-cut breakdown. So if market remained weak in the first half, I see some downside further on the Bajaj Finance counter. So 6616 is the close of Bajaj Finance. I see the clear-cut downtrend, and we can short it with a stop loss of 6750. On the downside, I see a support around 6400. So there could be a short-term target for the shorts. So 6400 on the downside, I'm expecting in the Bajaj Finance, and 6750 should be the stop loss. And on the long side, we have been witnessing some strength in the capital goods counter. So ABB is looking strong to me. So 8264 was the yesterday's close. For last 4-5 sessions, it has been consolidating and has been showing some resilience against the market weakness. So I see strength in that, and that's why I'm recommending going long in ABB around 8264. We can keep a stop loss at 8100 short-term traders for 1 or 2 sessions. So 8100 should be the stop loss, and ultimately I can see a resistance around 8500. So 8500 could be a target for next 2-3 sessions, and 8100 should be the stop loss. So ABB on the long side and Bajaj Finance on the short side.
Okay, let's take a quick break on that note. Thanks, gentlemen, for this. We'll come back with the pre-opening rates. Also, we'll have Kaitav Shah, the lead BFSI analyst at Anand Rathi Institutional Equities, to put the spotlight on banks. Well, the pre-opening session is indicating a big start. So the Nifty is up 160 points. It will get very volatile, actually, as the news flow continues to emerge till the 4th of June. So, don't get carried away by all of these drastic moves. I guess the best thing to perhaps do at this point in time is just wait and watch how things play out, because it could be a very volatile run. But let's ask this to an expert. In fact, we have Sneha Seth, the derivatives research analyst at Angel One, joining us now. Sneha, important time for the market, but what do you do on a hour-to-hour basis? So today, before end of day, what should the trade be? And what are the stocks to look at?
A very good morning, Sonia. If you look at yesterday's selling, it was the monthly expiry effect. However, if you see FI's activity, they have also lightened up their positions. The long-short ratio has declined to say 13% now. I believe at this point in time, 22,400, 450 is an immediate support zone. On the higher side, any recovery above 22,700, 800 zone will be very encouraging. I believe volatility will be high, so individual counters can be focused. One should avoid any aggressive bets in index. As far as individual counters are concerned, banking index was holding quite well yesterday. So I have a buy on ICICI Bank with a strict stop loss of 1100 and the target expected will be around 1150. Apart from this, Indigo was a top gainer in F&O space yesterday. So that counter is again a buy with a strict stop loss of 4040 and the target expected is around 4400.
Okay. Siddharth Khemka, thanks a lot for that. Sneha, have a good day and we'll speak to you again very soon. But Siddharth Khemka is still with us, so let's get a couple of cues going from him. Siddharth, another stock I wanted to ask you about, actually two stocks, was the battery makers, right? Amara Raja and Exide. Amara Raja actually had a conference call yesterday at 4 p.m. and the commentary was very bullish from the management. A lot of their segments are doing well, but the stocks have rallied quite a bit. At this point, does it still make sense to buy any of the battery makers?
Yeah, I think yes, the excitement with regards to the EV batteries that these guys are making. So if you look at Exide, they have got a good contract with the Hyundai and Kia. For that, they are also putting up a large factory. They have earmarked almost 5,000 crores for the lithium iron manufacturing project. Of which the first part would be about 1,000 crores in FY25. So I think, yes, there, if you look at the longer term picture, this the next phase of growth will be driven by these new initiatives, both for Exide as well as for Amara Raja. But having looked at the current run-up, I think the upside could be little less. The stock price movement could be more sentimental driven. But in terms of valuation comfort, we just need to see when and how these projects get implemented and from when we could start getting the revenues and profitability from these new projects. So until then, yes, the view remains positive, but purely in terms of valuation, one needs to be a little more watchful.
Okay, all right. Sid, very quickly, if you could tell us about Sunteck Realty as well. That stock in pre-open has opened higher post its numbers, but it's been one of the biggest underperformers actually in the real estate space in the recent past. Your view?
Yeah, so Nigel, if you look at in the overall real estate pack, Sunteck had been an underperformer. This is largely because they had been focusing a lot on the premium and ultra luxury segment. And that is where finally the growth is coming. And we see that the luxury offering and the execution has now picked up across segments. Now, the real estate pack, we have seen how the pre-sales numbers have been on a record tear. And if you look at for Sunteck as well, the pre-sales for Q4 was up 26% at 6.8 billion rupees. This is almost 30% higher than our expectation. And for the full year FY24, it has almost achieved its guidance of 20 billion rupees of, around 2,000 crores of the pre-sales. And we believe that FY25, the numbers could now see improvement with a lot of these projects being completion. That will lead to improvement in the P&L and that should drive the stock price going forward. So overall, I think we continue to be very positive on Sunteck. We have a target price of 640 and we expect a healthy 25% pre-sales CAGR over the next 2 years, fueled by the ramp up in the launches, the strong balance sheet, and the improvement in the execution and delivery of the projects.
Okay. All right. Thanks a lot, Siddharth, for joining in fact, giving us your view on a whole host of stocks. Wishing you a good Friday ahead. Well, let's move on then. S&P has revised its rating outlook for 6 Indian banks to positive on sovereign action. To discuss this and more, we have Kedav Shah, lead BFSI analyst at Anand Rathi Institutional Equities, who joins us. Hi, Kedav. Good morning and good to see you, Ben. Let's get a couple of basic details first out of the way. What kind of credit growth are you factoring in the coming year? That's FY25. And which segments do you expect to outperform?
Right. We are actually expecting a slightly higher credit growth than what perhaps Street is estimating. We think it could be anywhere between 14 to 15%. And we think it will be a more all-rounded growth this year. Corporate could also contribute. Retail has been the heavyweight for last 5 years. But we think this year it could also be corporate, which could be contributing more to this growth.
Give us a couple of numbers. How much was corporate credit in the past year and how much are you working with for the coming year?
Right. So corporate credit was still closer to double digits, lower double digits. We think this could inch up a bit. SBI in its fourth quarter results did show an outstanding performance within the corporate book, where sequentially it grew more than 10%. And this, if you combine with whatever is happening in the economy in terms of capex, if the policy continuity is maintained, then you will see capex coming in, because of which you'll see corporate demand coming in, both at the large corporate level and the mid corporate level.
Okay, was going through some of your, recommendations, and there's some stocks that you like in the PSU banking space as well, names like SBI, but we've seen big rallies here, right? Do you think we are still at the nascent stage of the rally in PSU banks? Is it a structural up move that you're looking at?
In terms of catalysts, it's easier to define near-term catalysts. There are still a few of them that are lurking around, including the bond market inclusion. Are they at the peak levels? No, in the past, within the cycle of 2005-8, between 2012 to 14, they have traded at higher valuations, and specifically talking about SBI. So I would still call it mid-stage, not nascent stage, but not at peak stage.
Okay, so mid-stage of the upcycle. So there's still more to go is what you're saying, correct?
There is a possibility, yes, depending on how the earnings pan out, of course.
Okay. Got it. Can you tell us, are you seeing any pockets of challenges or stress either in Tier 2, Tier 3 or in rural that could perhaps have an impact on these banks?
So we actually have a contra view on the rural markets. I think there is enough and more being said about stress in the rural markets. Whatever channel checks we've done as an institutional research house, as a team, I think we haven't seen that kind of stress, number one. Number two, what we essentially think is that if you look at the manifesto of the current government, and if they do come back, you will probably see rural incomes being an area of focus. If these two combine, and in fourth quarter commentary, a lot of FMCG stock companies did attribute to some green shoots in the rural markets. I think if you combine all three, there could see some amount of positivity in the next 3 to 6 months.
All right. I also wanted your view on credit cost. That's been a bright spot, right, in the last 12, 18 months or so. The problem is now the street is getting a little bit cautious on the base effect, and maybe the best news is already in the price. How do you see credit costs panning out going ahead?
Credit cost is always quite cyclical. I think it's not a driver of valuations for me per se. We generally look at the operating profit, pre-provisioning operating profit. If those numbers are panning out well, then I wouldn't be very worried on the credit cost. I actually never consider it as a driver of earnings. So if my top line in terms of credit growth is still intact, if you expect that the NIM has bottomed out for some of the banks and can improve, then it could still drive a re-rating of these stocks.
Okay, got it. You also like Karnataka Bank and City Union Bank, right? Two of the smaller banks. Can you tell us what kind of an upside do you see there and what are the triggers?
The triggers would be more in terms of, I think, the sustainability of the ROA. Fourth quarter has been good for some of these regional banks. If they're able to sustain these numbers, then there can be some amount of upside. I think catch-up play would be the right word for some of these candidates.
Okay, well, thanks a lot for that. Appreciate your time here. on CNBC TV18. Let's do one thing. Let us go across to Nimesh now to talk about the standout brokerage report of the day. Nimesh, over to you.
Hi, morning, Sonia. So today's standout is an M&M. Another upgrade for, on that stock, this time from Boffa Securities. So they've upgraded the stock now to buy from neutral, and they've raised the target price to 3,050, a potential 24% upside even from current levels. Now, Boffa says multiple growth levers and catalysts to play out over the next 12 to 18 months. They believe that the core business will see a market share gain, as well as some bit of turnaround is expected in the tractor business as well going forward. In fact, they expect the subsidiaries to contribute more going forward for M&M. So they see a consolidated EPS CAGR of 18% with a 20% ROE, and the valuation is still comfortable at 19 times price to earning on a consolidated basis. So a big upgrade to a buy now on M&M with a target price now to 3,050, a potential 25% upside from current levels.
All right. Thanks very much for that. I mean, this is the big one, right, in that sense, in terms of price targets for Mahindra & Mahindra. Now, Nimesh, thanks very much for that. Muthoot is what we want to focus back on. Abhishek is here with details on this one. Abhishek.
While Muthoot Fin has seen strong loan growth across, whether for the parent company as well as the subsidiaries. So standalone basis, their AUM has grown at 20% YOY and 6.5% sequentially. The home finance subsidiary over there, the sequential growth is about 14% in the AUM. Belstar MFI, the AUM growth is about 13.5%. Again, on the asset quality, they have seen massive improvement. Standalone company asset quality has improved to 3.28 versus 3.62 in the previous quarter. Home finance subsidiary, massive improvement over there, 1.88% gross NPA versus 3.5% in the previous quarter. Even the Belstar MFI, the ratio has improved by 6 basis points. In the con call, management has guided that they are optimistic with respect to delivering 15% gold finance AUM growth in FY25. However, they have also guided that there will be increase in cost of funds coming up. So DAM Capital has written on Muthoot Finance, they have a buy recommendation, increase the target price to 2125 versus 1700 that they had earlier. They say picture abhi baki hai from the management is what they have said. An AFL episode that took place on 4th of March, the full impact will be seen in Q1 FY25 for Muthoot Finance. Back to you.
Okay, picture abhi baki hai. Thanks a lot for that, Abhishek. Well, let's also talk about Amara Raja batteries, because there as well seems like picture abhi baki hai on the upside. There was a conference call yesterday at 4 p.m. and, the stock is in focus today post that. The management commentary was very positive, so a lot of brokerages have written on it as well. Now, they talked about how they are now in advanced discussions with for tech partnerships in lithium-ion cell manufacturing, which is the big focus area, remember, as, EV adoption increases. They have also partnered with telecom players in the new energy businesses. So there are several wings which are working for them, and they are in discussions with different auto OEMs and energy storage customers for cells and packs. So, both these verticals are firing away. JP Morgan said in the bull case, they are seeing a 49% upside for Amara Raja shares. They expect a fair value of 1,770 in a bull case for Amara Raja. They also talk about how the EBITDA margin is very steady at 14.5%. There are a lot of tailwinds from the auto aftermarket and the industrial segment, and that is something that will definitely drive EPS growth. So this is one space that perhaps could continue. I think the big trigger really is the lithium-ion cell manufacturing because of EV adoption.
Absolutely. Look at what has happened to Exide, right?
Yeah.
It's absolutely berserk in terms of the rally that we've seen. The first trades are up 80 points on the Nifty. 22,572 is where we are starting. So this is a good start. Much better than what we've had over the last couple of days. We hit that 20-day, close slightly 10-15 points above it, and you start with a decent 100-point higher start. So, the market's light going into the exit polls, going into the election results. So, you get a bit of a jump this morning, at least to begin the day with. Let's just take a quick look at what the Bank Nifty is at, 300 points higher. So about a 0.5% pop after yesterday's 0.5% rally. So banks are holding out on their own. You just heard a view from an analyst 10 minutes back. Mid-cap index starts 0.75% higher, 51,800 in the mid-cap index. And I think you've got the small-cap index, which is also starting in the green. There's about a 0.75% gain coming through there. By the way, for the week, Friday to Friday, these mid and small-cap indices are down just about 0.5%, about 1% or so. Of course, Friday is just starting. We'll see how it goes, but it's a good start, to say the least. But it's all about stocks. Sonia has got the rates there. Sonia.
Well, thanks a lot for that. So, since you were talking about individual stocks, right, let me take it straight to some of the result reactions that we've had. First up is Muthoot Finance. The numbers were pretty strong. So the stock is up almost about 4%. Let's look at it. AUM growth of almost 20% year on year is what Muthoot Finance has reported, and the street definitely likes that. The other one, which has been a darling of this market, is Bharat Dynamics. The operational performance has been very strong. The revenues are up 7%, EBITDA is up 73%. And I wish I could have showed you the chart of Bharat Dynamics here, because not just today, but the rally has been spectacular over the last 1 year, right? Let's look at Apollo Hospitals, another favorite of this market, 3% higher. The Q4 has come in above estimates. The average revenue per bed has improved 5% quarter on quarter, and the street is giving a thumbs up to Apollo Hospitals. Let's move to Sunteck Realty, a space that has been buzzing quite a bit. Pre-sales are up 26%, the highest ever FY24 sales at 1,900 crores. So Sunteck Realty, it's just about flat right now. The other one is Bector Foods, 1.5% higher. EBITDA has gone up 22%. Margins have improved, so the street likes that. Yatra, there's lots left to be, delivered for Yatra. The stock is under pressure because the numbers have been weak. EBITDA is down 80% for them, so not looking good. Amara Raja Batteries, we just spoke about that. There is positive commentary from the management in the conference call yesterday, and they are in advanced discussions for tech partnerships in lithium-ion cell manufacturing. So Amara is really the stock to look at. But even here, right, I mean, look at this. The advance decline ratio well in favor of the advances right now. Almost 1,800 stocks are looking pretty good. But once again, getting back to this number on the board, 100 points higher now on the Nifty. So very strong start. Let's see if we can build on to these gains. Back to you guys.
All right. Thanks a lot for that, Sonia. Well, Muthoot Finance, that's one of the big gainers actually in the F&O market. As Abhishek pointed out, the DAM capital note as well, picture abhi baki hai. Gold prices, they're expecting to remain firm. They're expecting them to gain market share, and they're expecting the ROE to hover around that 18 to 19%. So explains why that stock is flying away in today's trading session. A couple of other big winners, Torrent Power. Take a look at that stock, up close on 6% as we speak. GMR Airports, yesterday it got clonked back. Well, today, in fact, that stock is pulling back. It's up close to around 4% as we speak. Oberoi Realty as well is up close to around 3%. In terms of top losers from the F&O basket, you have Ipca Laboratories, that's down. APL Apollo has come in for some profit taking. Page Industries, yesterday it surged in the final hour of trade. Well, that one, in fact, has come in for some profit taking. A few more gainers. You have Lux Industries. That stock, the numbers look quite good. There was margin expansion. Lux Industries should come up for you in the screen. I think the stock was up close to around 3.5 to around 4% initially. Now it's up close to around 6%. Orient Electric, they have appointed a new head at the top. So it seems the street has taken that positively. For the time being, the stock is up close to around 3.5%. Or thereabouts. Zomato, that's one of the lone losers. It's down close to around 3% as we speak. So that stock's under some pressure. India Nippon, that's another stock that's doing quite well today. That stock's open up with a gain of close to around 3%. And let's wind this down with a few losers then. Some stocks reacting to its numbers. Welspun Corp, there was margin compression out there. So that one's down close to around 5%. Your Swan Energy, that stock is under pressure as well. I think it's locked in lower circuit with a cut of close to around 5%. And Global Spirits as well, that one as well is seeing a bit of a cut. So the headline index is holding strong with a 100-point gain, but plenty of stocks in the broader markets doing nothing of their own.
Market breadth is looking very solid. It's about 4:1, in favor of advances right now. So it's a good-looking screen. Nifty is up, almost 3 digits, 100 points. The mid-cap index is up. The Bank Nifty is looking up as well. A few other names right now which are moving. The number one volume-led gainer right now is Idea, right? I mean, it's in a way, in that sense, it's a retail favorite as well. So 15 rupees, 15 plus now. I think it got to 15.4 and then kind of sold off, which was the recent high in the move up. So this is interesting that Idea is up this much now. Paytm, of course, I think we mentioned another 5% is coming off extremely beaten down levels. So 396 on Paytm. Motherson has got huge volumes, 2% higher, 155 on Motherson. GMR we mentioned. Look at Exicom, the EV sort of, it's an EV play because of the EV charging systems that they make. 10%, 344 on Exicom coming through there. Solar Industries is up 3% at about 9,420. It's a big name, but it's got huge volumes for this point in the day. And that's the reason why we're mentioning it. at this point. Torrent Power is up 4%. And this power, power demand, by the way, has hit a new all-time high, 250 gigawatts. It's higher than we made a new high yesterday. We kind of sort of on that path of newer and newer highs. Last year, the high was made in September, 240. And we're at about 250 at this point in time. Loda is up 4%, 1372 on Loda, that's Macrotech Developers. Mankind is coming up with a 3% pop, stocks at about 2162. There is Prestige, which is up 4%, large volumes, 1594. And so it goes. So this is, the bulk of what's coming up with gains and volume-led gains, mind you, that's more important. The biggest volume-led loser is Zomato. I mean, it's not as if there's a big price damage or anything. It's down 2%, about 177, but volumes are large for this point in the day. Look at that, 9 million shares on Zomato. What else? Cummins India is down 2%. Cummins, of course, had a big move yesterday as well on the downside. And that's coming up with a bit of a sort of selling pressure. IGL is down 1.6, and Welspun Corp, we mentioned, I think made a mention of it, 6% lower on Welspun Corp. So that's at about 566. I can spot a shipbuilder, Garden Reach, down about 1.7% or so at about 1389 on that one. More with stocks in a bit from now. But I think our market master of the day is ready with us. Mahesh Nandurkar is India strategist at Jefferies. Mahesh, good morning. Good to have you with us here. Thank you very much for your time. So let's talk numbers and market reactions. Let's assume that, we get, it's a sort of comfortable majority for the BJP. That's what the election throws up. What does the market do then, Mahesh? Is there big upside here? Or do we kind of just sort of recoup what we've lost over the last couple of days, go back to say 23,000 or something and then cool off a little bit? What's the likely roadmap? This is, of course, the near to medium term.
Yeah, thanks and good morning. So I think from the near-term perspective, we've already seen a lot of investor positioning, especially from the domestic investors, domestic retail investors, quite adequately positioned. So my view is that from a near-term perspective, a comfortable majority is probably already there in the price, especially in the mid caps and small caps. I would say on the large cap side. I think it's one can probably say that there could be some upside, especially because we've seen large foreign investors selling over the last few months. But I believe that maybe from here on, the mid cap and small caps could possibly take a bit of a breather because we believe that the domestic retail investment activity in the mid caps and small caps, specifically and broadly on an overall basis as well, is at a fairly elevated level. And what we've highlighted in one of our recent notes is that in the last 4 or 5 months, we've seen that the total domestic buying in equity markets is roughly at about $7 billion a month. That's a staggeringly high number. It's up nearly 3x from a year-on-year perspective. So I think the domestic investors are adequately positioned in my view, and maybe we could see some of that unwinding in the near term.
Okay, so I think, Mahesh, hi, good morning. You made some very interesting points. You're saying that a comfortable majority for the BJP is there in the price in the near term. In the longer term, of course, things are positive, but in the near term, you believe that mid caps and small caps could take a breather. Now, if you just go back to history, right, of during election times, what has really happened? In 2014, when there was this inkling that the market had that Narendra Modi would come to power as a prime minister and there would be big development, etc., the market had a massive rally going into elections, and then post the election verdict, there was a bit of a cool off and there was hardly anything left. Do you think we are in that kind of a situation where the market has priced in almost everything? Now, post this, we could just perhaps see a time correction for a bit in this. Is that the best way to look at it?
Yeah, Sonia, I think that looks like the most likely scenario to me because as I mentioned, we have seen a fair bit of run-up already, fair bit of investor positioning as well. The only segment of investors which is not well positioned on India or Indian markets at this point in time is the foreign institutional investors. So there's a good chance that maybe they come back in, but probably that happens more on the large cap side. But on the mid cap, small cap side, I think probably we might need to prepare ourselves for I would say a flattish market for from the near to mid term.
Hi Mahesh, good morning. Nigel on this side, and good to see you. When today is virtually the final day of earnings, the first quarter earnings. How do you see things pan out? I recall at the start of earnings, I think we had a chat. I was reading one of your notes as well, and I think you were working with mid to a little higher single-digit growth for the year. What are you factoring in, and how was the past quarter in terms of earnings?
So for FY25 and for FY26, we are looking at the broader corporate earnings growth to be in the range of around 12 to 13% growth. We definitely expect a higher earnings growth for domestic cyclicals like the industrial, manufacturing, infrastructure, even banks. So that could be in the range of 16-17%. And some of the outward-facing sectors such as the IT services and the others, probably the growth will be slightly lower. So yeah, so about 12 to 13% on an overall basis, but domestic, oriented in the domestic cyclical sectors, will see a higher earnings growth. On the on the quarter that has gone by, we've seen, I would say, probably a similar trend, wherein we've actually seen some earnings upgrades coming through for some of the names on the capex cycle side, and that's always good to know because that has been our sort of core thesis from a stronger positive longer term outlook perspective. Because investment cycle is really going to keep the GDP growth and the overall corporate earnings growth at an elevated level, and that is happening as we speak. So, I mean, just to clarify, the thing that I mentioned about some of these mid caps and small caps and maybe a breather from the near term perspective is near term, because ultimately a lot of these names are definitely an attractive play on this industrial recovery, the real estate recovery, etc., that we've been speaking about. So, those sectors, those stocks, would be quite good from a long term perspective.
Mahesh, just a quick word on when the sort of, and of course, we're all sort of talking about the base case, because if it is not the base case, it's as someone put it yesterday, black swan, so we don't know, right? But let's just assume that it is the base case and we get what the market is wanting. We've heard the Prime Minister talk about the 100-day agenda, etc. What would be on the market's mind? I'm sure that, in your conversations with foreigners, this comes up as well, right? It's promised kind of a action-packed first 100 days. Just what's your sense? What could be what could really fire up the imagination of the market from here, in your opinion?
So I think from the financial and the market investor standpoint, one of the key events within the first 100 days is obviously going to be the budget. And my sense is that we've already seen the roadmap for the budget in the February budget. So I think the July budget will probably be just a small bit of tinkering here and there. Most likely we will get a little bit more clarity on how the affordable housing scheme is going to be implemented. So that in the bit of limelight, I would say. But other than that, not really too many things, I would say, from the budget point of view, because we've already seen the budget. There could be some other announcements, and maybe from what we're expecting, not necessarily just from the 100-day perspective, but in the next 5 years or so. Obviously, things that would include more development on the power distribution side, as that there is that outstanding bill, the Electricity Amendment Act, which could see the light of the day, in this term. And which would mean that, if that were to happen, the power sector, which has already been a key focus for the market, would continue to remain in the focus, in the times to come. There is also this talk about, incremental focus on the trade agreements, the foreign trade agreements, and especially one with the UK. And I know that the UK itself is going to their own elections, but maybe, a few months down the line, we could see some clarity on that. And there could be, a whole bunch of things that, that could be happening. Difficult to point out what exactly will happen in the next 100 days itself. But from the market investor standpoint, I think market is clearly discounting longer term growth. And many of these things would therefore impact the market and the stock movement over and above what might be announced in the first 100 days.
Okay, so the first 100 days of the government are important. There's the union budget as well. So is there policy continuity? Is there policy stability? That's something that the market will look forward to, right? Mahesh, always great speaking to you. I mean, we can go on endlessly and, debate what could happen, what shall happen, but nobody really knows until the event is out of the way. So we'll try and touch base with you again, post the election verdict. Anyway, for now, the market is not bad at all. It's a 150-point gain on the Nifty. The sensex is up 500 points. So clearly this market is using the fall that we've seen in the last, couple of days as a buying opportunity. So the dips are getting bought right now. Whether they last through the course of the day, time will tell. But for now, things are looking good. Blue Star is the first management on the show today. The company reported a strong set. Revenue jumped almost 27%. EBITDA margins expanded. But there was an exceptional gain of 170 crore in Q4 because of the sale of the land parcel in Thane. So we have B. Tyagarajan, who's the MD of Blue Star, who joins in now. Mr. Tyagarajan, good morning. It's always nice to see you on the channel and good to see you early this morning. I wanted to start by asking you about, the usual questions, right? How is growth looking? I think Q4 was very strong for you. But do you think it's just because it's come off a low base? And what kind of growth? Do you think this 25, 30% growth is something that you can eke out given, the situation? Climate change, the heat wave and all of that. Do you think that growth rates will only improve from here?
Good morning, Sonia. It's a pleasure interacting with you. In your preamble, there is one small correction. There was no exceptional income in FY24 at all. Okay. What you are referring to is FY23 had Thane sale land. Despite that, we had performed extremely well. In FY24, there was no such one-time exceptional income at all. It is pure operating performance. Now, going forward, we had interacted when the season was about to begin. I had stated that we all expect somewhere between 20 to 25% growth. But towards the end of March, the temperature shot up. And contrary to our belief that during an election season, the sale can slow down, the market did extremely well. The sale in March alone was around 40% growth, and in April, it was over 70%. Then I had corrected the estimates, telling that, look, the growth now cannot be somewhere around 25% or something like that. It could be even 40% growth as far as the summer season is concerned. Now, the month of May also has gone on very well with heat waves at several parts of the country. And I think it is another month where the sale is over 60%. So therefore, it is quite probable that the first 3 months of this financial year for room air conditioners business can be over 50% growth. And this sets the tone for the rest of the year. Having said that, the new concern, in April, the concern was there was shortage of material because the entire industry had not planned for that kind of growth. Then there were installation delays. Now, May, we all could bounce back and manage that growth. There is absolutely no problem. The new development is the inflation in the freight costs, specifically the overseas container charges and ocean freight, and the raw material prices, which are skyrocketing.
I just had one follow-up. Yeah, sorry, I just had one follow-up. This is a remarkable statistic. You're saying that in the first 3 months of FY25, you've seen a 50% growth rate in room air conditioners because of course, the heat wave. And personally as well, I don't think I have used air conditioners at home for such a long time span in a day ever, right, in my life, just because of how hot it is here.
Because of the latest bill, Sonia?
Yeah.
The electricity bill?
I don't want to even look at it.
I got mine, and I must say it was not as bad. It was bad, but it was not as bad. This is for the month of May. And of course we'll, the cycle basically. So it covered a part of May. But, and that's interesting, right? For people like Blue Star, for companies like Blue Star to make energy efficient ACs, I think that's going to be a big one.
Correct.
It costs more, but I think the payback could be pretty significant. Pretty fast.
2.5 times the January bill, right?
Wow.
to see, but yeah, I mean,
that
at least
is
double.
crazy.
That was mine.
And it could only get worse, right? Mr. Tyagarajan, I want to understand that from you. So this 50% growth rate, right, in room air conditioners in the first quarter of the fiscal, is that something that you think could sustain through the course of the year? Because I'm asking because April had peak sales, best sales, but how has May been so far? What is the expectation for June? Because this is not something that is restricted to a single quarter anymore. I mean, climate change is something you're seeing through the year. So do you think that these growth rates can sustain?
3-4 points. Number one is that it was over 70% growth in April. It will be over 60% in the month of May. It could as well be over 50% in the month of June. So overall, it could be even 60% growth in Q1. Having said that, this growth we are talking about in comparison with the summer season of last year, which was a bad summer season. It rained throughout, and over the 2022 summer season, the growth was not there at all. It was a flat summer season. So therefore, we should not get carried away by 50% growth. I am of the view that sustainable basis, the CAGR over next 5 years could be anywhere between 15 to 20%. This is the period, like China, we will leapfrog into a very different kind of penetration. So today, the penetration will be around 8%. We will be reaching somewhere between 20 to 25% of penetration by 2030. And remember this category. This category, it is not one, if it is a refrigerator, it is one per home. If it is washing machine, one per home. Air conditioners have potential to be more than one in a home. And coming to this power consumption issue, earlier it used to be the case where I can afford an air conditioner, but who will pay for the power bill? So year after year, with each energy label change, the power consumption has been brought down. So the approximate figures I will tell you. If you have bought an air conditioner in year 2000, if you are buying today, it will consume only 20% of the power it consumes. So therefore, the power consumption is no longer an issue. While for a few weeks, people may use for 7-8 hours or so, the general usage is not that much in India. So therefore, I do not see that as a headwind at all. The raw material prices could be now the China has revived, and you are seeing copper prices shooting up, and steel and other metals also will follow like that. And there is going to be even shortage of material if the growth is going to be like this. Another insight I will give you: the room air conditioner, the key raw materials that we use are similar to that of EV. And the growth of both are going to be in the same period. You consume copper, you consume a lot of electronics, and the thermal management system in an EV and an air conditioner manufacturing is one and the same. And the variable speed drives that we use are similar to that. And in China, that's what happened. Most of the component suppliers started focusing on EV rather than air conditioners. So there is going to be a period where the industry will leapfrog, and it is a golden period for the industry with the domestic manufacturing growth happening. But at the same time, to manage the supply chain and to manage the cost is a different game altogether. That's what we are preparing for.
All right. Thanks very much, Mr. Tyagarajan. We had a bunch of other questions, but very interesting statistics. And I think that power statistic is very important. About, ACs bought now use about 20% of the power as compared to an AC back in 2000. But I wonder what the cost difference is also now, of course, for some of these inverter speed ACs, etc.
If you have Mr. Tyagarajan, maybe we can check that. Mr. Tyagarajan, do you want to come in over here? The power consumption is much less, but what about the cost of the AC?
Yeah, you will be surprised to know in the past 6 years, the price has remained the same.
Oh.
Okay, all right.
And it has not increased at all. Thanks to the competition, And the other question that you will often ask me is, what is the margin outlook? I had maintained some point of time it could be 10%. I brought it down to 9.
Yeah.
I think it's a 8% EBIT industry. And therefore, we are making sure the price is also maintained.
Yeah, absolutely. We'll leave it there, Mr. Tyagarajan. Good to have you with us here as always, and interesting chat. We'll have you back with more as over the sort of next many weeks as well, as we get through this sort of summer season. Let's move across to another company. Apollo Hospitals is the next management of the show. The hospitals margins and profits came in better than expectations. Occupancy for hospitals were flat at 65% sequentially. Let's discuss this. And of course, the outlook for FY25, more importantly, with Sunita Reddy, Managing Director at the company. Ma'am, thanks very much. Good morning. Great to have you with us here. Thanks for joining us here this morning. Just to begin this conversation, if we can get the basic hygiene numbers out of the way as we finish one year and look ahead into the next one. What is the expectation for FY25 at an overall hospital level, ma'am, on revenues and margins?
So if you look at our Q4, total revenue was at 4,944 crores. Our EBITDA was at 640 crores. So we grew the top line by 15% and EBITDA grew by 31%. PAT was at 250 crores, a growth of 76%. So I think for Q4, we've really established the momentum to go forward in the next year. And we're actually seeing this momentum play out in April and May. Having said that, our other subsidiaries, which is Apollo Health Co, actually did very well, registering a revenue of 2,027 crores and an EBITDA of 12 crores. So they have actually turned EBITDA positive. This happened in the last quarter, and they are on this trend of really starting to contribute to margin. And Apollo Health and Lifestyle was at 335 crores. And again, we've seen good growth there. But more importantly, the diagnostic, which is a clear, which is a very strong vertical, has been growing at over 35%. And their revenue was at 117 crores. So again, growth with good margins in three of the healthcare services, Apollo Health Co, Apollo Health and Lifestyle. So
overall, ma'am, for FY25, should we expect a similar 15% kind of top line growth, 12.5% margins? Is there room for improvement? What could you put some numbers to it?
Yes, I think in healthcare services, it's having shown 17%. I think it's reasonable to expect that we will take this forward because currently we're at 65% occupancy. And our focus this year is on increasing volumes, and that will get reflected in occupancy.
Hi, good morning, Ms. Reddy, and good to see you in. So occupancy moves up from around 65% to what levels in this year? What are you working with regard to this guidance? And also the ARPOB, what is the number? I mean, what could the increase be potentially for the coming fiscal?
So while we're at 65%, we're looking at 68 to 70%. Having said that, our asset utilization has actually moved up because we've reduced our loss. So to give you an example, our hospitals, some of the metro hospitals, which are at 80% occupancy, have an R loss of 4. So when we've been decreasing the R loss, not only has the ARPOB gone up, but it has also given us headroom to offer more beds, and therefore occupancy is there's always headroom to improve occupancy, and this is our focus for the next year. Currently, volumes grew by 6% for and 9% for outpatients.
So improving your occupancy is the focus for next year. I also want to understand in the hospital space, Sunita, hi, good morning. This is Sonia here. In the hospital space, do you have any acquisitions planned, any further acquisitions? I think you recently acquired the 250-bed hospital in Pune. That was a couple of quarters ago. And you have a plan to add about 2,300 beds over 8 locations over the next 3 years. So what does the acquisition pipeline look like?
The acquisition pipeline is, I think, every year we do about a bolt-on acquisition. And I think that we are going ahead and doing this. But I have to say there are very few assets available, because the way that Apollo does it is that we need to complete our networks in the south, in the north, and the west. And to do so, we need to acquire these bolt-on assets. We have done Pune, we have done Kolkata, and Gurgaon. So these will come live. And one in hospital in Hyderabad. These 4 will come live in 25-26. And we continue to look at bolt-on acquisitions, hopeful that we will be able to announce one this year as well.
Have you looked at the HCG asset, Ms. Reddy?
Yes, we've looked at it, but I think, our oncology vertical is growing very strongly. It grew by, by 40% in revenue terms, and total revenues were at, we were at 2,200 crores of revenue. So definitely the oncology vertical is growing. We've made investments in oncology, and I think that there is a huge focus on this.
So you looked at the asset, but you're happy growing your oncology arm organically itself? You don't want to look at an inorganic growth? Because this asset's available.
No, we are looking at some assets in the oncology space.
But you're not looking at HCG at all?
HCG, because I think we have a parallel, network which is very similar.
Okay, all right. I think you did mention something similar last time as well. Well, ma'am, one thing which the analyst from JP Morgan points out, and I wanted to put this to you, is that your revenues to GMV, that ratio is low at about 35%. They point out that this number was in the third quarter of 24 was 34%. In Q4 of 23, that number was 43%. So would you like to comment? I mean, what's going on and what's the outlook here?
So I think we had 687 crores of GMV. And if you look at, conversion, it is close to 40%. And going forward, we have so far been measuring mostly pharmacy online, which is really the biggest contributor. The second is really the lead generation into the hospital network. The third is the teleconsults, and the fourth, diagnostics. I think all of these revenue streams are picking up, but more importantly, we're launching the fifth, which is insurance broking. We've tied up with Bupa. And with this, I think the revenue will certainly grow. There's significant margins, 15% margins in the diagnostic space, and 10% in the insurance, 15% in the teleconsultants. So, I think
in diagnostics, you said the margins are now 11%. You're saying that there is scope to take it to 15%, is it?
Yes, yes.
Okay, by when is that?
By the next year.
Okay, so diagnostics business margins from 11% can get to 15% by FY26.
Yes.
Okay, and in terms of growth drivers for diagnostics, you were telling us about the growth rates, but what are the drivers? Are you looking at any other areas such as specialty, wellness diagnostics, anything else that you can add to your portfolio?
Yes, currently our revenue from pure diagnostics for this quarter was at 117 crores with, like I said, close to 15% margins. And what are we looking at? I think, if you look at, first of all, the diagnostics, we have over 3,000 networks. The size of the network is 3,000. But beyond that, we have clinics, which are 250 clinics. And through that, we're really looking at preventive healthcare. And all of this should convert into more of diagnostics. And therefore, I think that the revenue intensity of the clinics will also improve, because we are adding radiology, we're adding, specialist clinics. So the primary care network should grow very strongly.
Okay, Sunita, thank you for joining in and appreciate your time here. Have a great day. And thanks for always, speaking to CNBC-TV18 and giving us a view on your business. By the way, let's just get a quick check on the market. It's still holding steady. So it hasn't really given up on its gains. The Nifty is up 130 odd points. When we come back from the break, we'll be joined by Surendran Cheman Kotiel, who is the CEO of Metropolis Healthcare, to discuss their business outlook and performance for the quarter. Stay tuned.
Welcome back. Well, as promised, let's get chatting with the management of Metropolis Healthcare. We have Mr. Surendran, the CEO of the company, who joins us on the show. Hi, sir. Morning, and thanks a lot for joining in. Well, before we get to the business dynamics, give us some clarification. Why did Ameera Shah step down from the MD position? If you could, fill us in with a quick comment on that.
Good morning, and good morning to your viewers. Now let me clarify. Ameera has not stepped down. Actually, Ameera has stepped up as the chairperson of the company. Dr. Shah, who is the founder and chairperson, has moved into the chairman emeritus role. So Ameera is assuming a higher responsibility as the executive chairperson of the company.
Okay, so no worries over there. You're saying it's a step up rather than a step down. We got that. So off MD position into the executive chairperson role. So thanks for clearing that, Mr. Surendran. Let's focus on your business aspects then. The wellness testing as well as specialized testing. Well, that's seen a good growth in the past year. And now I think specialized tests, they contribute closer to around 36%. And if I got that number right, the premium wellness is approximately mid-teens, around 15% odd. What's the growth trajectory on both these two segments that you're working with for FY25?
Yeah. So if you look at our quarter four results, we had a strong quarter. We had core revenues grew by about 15%. And the core revenues actually growth is fueled by both wellness as well as specialty segments. Wellness segment, the premium wellness segment grew by about 22% on a year-on-year basis. And our specialty grew by 16.5% on a year-on-year basis. So we see both these segments, specialty as well as wellness, further making it better during the year and, going to fuel the growth in the year to come.
Okay, so that is the specialty in the wellness business. Mr. Surendran, good morning. And now that you've assumed, the role as CEO, I want to understand what is the guidance in terms of the mid-teens growth. Earlier, that was mid-teens growth is something that you've been talking about. So what is the way forward now? How much will you get from mature markets? How much from new markets? What is the overall volume growth that we're looking at over FY25 and 26?
Okay, let me explain this. We had 15% core revenue growth in the last quarter, right? And out of the 15%, 7.5% growth has come from the volume growth, and 7.5% has come from the realization, right? And all our focus market, which are our key markets, 5-6 key markets, they grew almost about 12-13%. And our new market, which is the tier 2, tier 3 towns, and grown by more than 24% or so. So the growth is largely coming from the newer market that we are entering into, and whereas we are holding our key markets. Now, Mumbai is our, what you call the strong market, flagship market. Mumbai grew by 20%. In fact, entire Maharashtra, the growth trajectory is very, very exciting and very, very, promising in the days to come. So it's actually a portfolio play. We will be growing both in our focus market, our seeding markets, and our new markets as well. It will going to be a portfolio play, and all the markets must be keep kicking in the days to come for us.
So given that you're looking at newer markets, the mature markets as well, is it fair to assume that you can further build on to these margins? Your estimated margins are around 25.5% to 26%. But are there any more triggers or levers to build on to this?
So 25.5% in quarter four was the best quarter for us in the last year, right? And going forward, we definitely see these margins going up by 0.5 to 1% better. See, please remember, every year we are adding around 24 odd labs. Last year we added 24 labs. This year we are adding another 24 labs. This actually leads into dilution of the margin by about 1%. So that is going to continue for 1 or 2 more years, because we will be keep adding newer and newer labs, particularly in the regions of North and East, where we wanted to geographically expand, So that growth will continue, and that laboratory expansion will continue. And also the center expansion will continue. We had added 550 centers last year. And this year also, I see the numbers going up to 500 to 600 numbers in terms of the center expansion. So this will definitely give a little bit of dilution in the margin for a short period of time. But this is a good thing to do when you look at a long-term basis. We are really establishing good quality diagnosis across the country, across the geographies in India. So that's a good investment to make. But having said that, we are looking at productivity improvement opportunities within the organization, and maybe our digital assets that we have already invested in will getting further stronger, and which will lead up to productivity improvement in the year to come. So maybe 1% plus EBITDA margins from what we left at before is going with the guidance in the year to come.
Mr. Chamal Kutul, good morning, Prashant here. Now, in your results, as part of the results, you highlighted that the discount percentages in the B2B segment are lower in FY24 as compared to FY23.
Right.
So it kind of indicates a reduction in competitive intensity. Can you sort of say that is the case for the overall business as well, in terms of discounting, etc.?
So, Prashant, I would not say that the reduction in discount is purely on the basis of lowering the competitive intensity alone, but we have made some very good investments in the B2B segment. We thought, it's not necessarily the price which will play out there. We concentrate on the top end of the B2B segment rather than, going after the long tail of the B2B segment that we had. And on the top end of the B2B, we made some investments in terms of improving their experience. We invested on a B2B portal, the partner portal. We invested on some relationship managers, and we have made some basic fundamental changes in the way we operate in the B2B segment. So that also helped us to focus on the top percentage, the top 20% of the clientele, and which helped us to reduce the discounting and stay stable there. So going forward, our focus will be on the top end of the B2B clients on the B2B segment, and not so much on the long tail that we have.
Okay, all right. You're in this mid-teens growth, sir, as you mentioned, for the partial specialized test and premium wellness business, well, it grew very well. But on that base, what are you expecting? Last year it was 16 to 22%, as you told us. But for FY25, what are you penciling in for both these two segments?
Okay, let me tell you, see, wellness is 15% of my total portfolio.
Yes.
And I clearly see there's a good headroom of 4 to 5% more in the next couple of years. So wellness awareness in the entire country is increasing. People want to go and do their health checkups on a timely basis. And we are also trying to engage with our customer on a 360-degree basis on the channels, like, for example, on our centers, and they walk in on the digital channels, and also through the life cycle management, we reach out to the customer. So we are getting good response on the wellness segment. I clearly see the wellness segment taking a growth of 20 to 25% year-on-year basis, and helping us to make this portfolio as big as 18-20% in the next 2 to 3 years time. And similarly, on the specialty, we are making a lot of investments on the high quality, high-end test, and in terms of, let's say, genomics and molecular biology, etc. So making some investments. And also we are adding the test menu on all the therapeutic areas like transplants, neurology, nephrology, oncology. We're making a lot of investments. They're also making our sales force good enough to go and meet up with the specialized doctors. So all this put together, I'm quite optimistic about a good positive movement on the overall specialty segment. So currently it's going about 16%. I would definitely want this to be in the range of 20% going forward.
Got it. So we've got both those two out of the way. 20% for specialty, and wellness segment could grow by nearly around 22 to 25%. Mr. Surendran, if competitive intensity is fading a little bit, it could give an opportunity to buy some of these, smaller size companies, and you have some cash balance as well. Is inorganic growth something that you're actively looking at, and could we hear about something in the first half of the fiscal?
Yes. So, yeah, you are right. The pricing competitiveness is really coming down because everybody is realizing that it's better to stay prudent in this industry. And hence, we really clearly see some amount of stability in the last 12 months in terms of pricing stability. We are definitely looking at some acquisitions, right? Which will, we basically look at acquisition from two lenses. The first lens is, can I get some good acquisition which will complement my geography expansion, particularly on the north and east part of the country? If we get some good acquisition, good assets, we'll definitely look at it. And also the other lens we're looking at it is the skill set in terms of complementing in terms of skill set. If I get some good, high quality, high specialized areas of diagnosis assets available in the country, we will look at it. So these are two lenses that we are looking at. Our team is definitely doing all kind of due diligence, and in the event we come across a good asset, 1 or 2 bolt-on acquisition, definitely on the cards during this year.
So if and when you close these acquisitions or assets, right, you've earlier said that you won't look at taking debt at beyond 2.5 times EBITDA. Just want to confirm that. Will most of these assets be acquired through internal accruals, or are you planning to take on any debt? If yes, how much?
See, this all depend upon what is going to be the size of the asset, right? And if the size of the asset is smaller, definitely we have internal cash accruals. We'll use the cash available with us. But if the asset is relatively bigger, then we will need to look at other avenues like a debt or maybe, swapping the shares, So we will look at all the options and depending upon the size of the asset, we will take a call when it comes closer to the acquisition.
All right. So you're saying when you talk about swapping shares, the acquisition that you're looking at could be a listed company as well?
Not really. I would not like to comment about it, before it really get matured about it. So we are thinking about some. Basically, see, we have mentioned in the past also, we are looking at bolt-on acquisitions. So you must read it from that lens, So, bolt-on acquisitions, our strategy, maybe a couple of bolt-on acquisitions is what really we are focusing upon.
Okay. Finally, you earlier said that the margins may see some pressure because of the new lab rollouts, but you also spoke about some cost optimization which could offset that. Can you tell us what is the cost optimization and what would this margin pressure be? I mean, just net, what would the impact be on margins?
See, pre-COVID, we used to run on a 26 to 27% EBITDA, and I think that's a decent EBITDA in this industry. And we closed last quarter with 25.5%. So our endeavor is to bring closer to the pre-COVID EBITDA, in the year, this year or maybe by the end of next year. We want to definitely bring it to the pre-COVID levels of EBITDA. Now, the levers available here are basically 2-3 things. One, of course, is we want to expand our B2C business. B2C business comes with relatively higher margin. So, if we are expanding the centers, we are expanding the labs. I mean, we are also, amplifying our contact to the specialty doctors. All this should help us in terms of improving the B2C business, which is definitely going to help us improve the margin. And secondly, we have done a lot of investment on the digital assets, improving the technology space. And that's going to give us a lot of productivity enhancement in the days to come. And this should really help us to reduce some kind of cost. And we are also looking at the whole material productivity because good negotiation with the vendors and using some best practices, benchmark practices across the company, we should be able to reduce some level of cost on the material. So all this put together, we will definitely see some improvements in the margin. But like I said, when you're expanding 25, 30 labs every year, it will have a dilution of a margin, maybe about a 1% for till the time we keep expanding in the labs. And maybe I see this year also we're expanding labs in the same proportion. Maybe later, the lab expansion will slow down a little bit, and then you will see further improvisation on the margins.
All right, we leave it there, sir. Thanks very much for your time. And, we'll speak once that acquisition happens or other developments as you outlined. Appreciate you sort of coming on. The market's come off. We're up about 75 points, so it's not as great as it was when we started. But and I think we've sort of course, we're below the opening levels. But it's not a bad-looking screen either, with market breadth, etc. Still, okay, market breadth actually is turned. The advanced decline line will come up. You've got about 1,300 stocks down and about 1,000 stocks, just under 1,000 stocks, which are higher right now. So there's been a bit of a flip which has happened from the time that we started. I just want to put out a few names here on the downside. PFC is down 3.25%. It's the biggest volume-led loser right now. Schneider is down 5%. It's got huge volumes on it. And there is names like Ipca Laboratories down 6%. None of these were in the mix early on when we looked at these rates at market open. Welspun, of course, it was 6.5%, 7% lower. Linde India is down 4%. There is PNB Housing, which was down about 3.5%. Shakti Pumps, which has seen a runaway rally, is down 5%, so a bit of a pullback. We highlighted Swan Energy in the morning as part of top 10. That's down 5% now on decent-sized volumes. And Ice Maker Refrigeration, 6%, almost 7% lower at about 670 or so. And I mean, it's a longer list, but these are the biggest volume-led cuts that we've got going on in the broader markets. We take a break. Rohit Srivastav of India Charts will be with us with his perspective on markets very near term around elections verdict. That's coming up in just a bit from now. Okay, welcome back. The market is what we're focused on now. 60 points is basically gains have been cut in half, from the time that we started trading, which is about 50 odd minutes ago. So 22,545 is where the Nifty is now at. Rohit Srivastava is founder and strategist at IndiaCharts.com. Rohit, great to have you with us here on the program. Thanks very much. So it's an interesting time. But first, I want to sort of ask you about the massive flip in terms of index shorts from FIIs. On end of day on Wednesday, that number was about 5,000 contracts, right? That's now almost 2.97, almost 3 lakh net shorts in index futures. That is substantial. Is that, would you reckon that's largely hedging? Is that, and somewhat, of course, expressing a view as well? Just start there, Rohit.
Yeah, so there is some expression of view, which means possibly the FIIs see some risk. Remember that FIIs and clients are at the opposite end of the stick, and the client side positioning also is similarly gone up. Now, there's something peculiar about this positioning shifting, very, very fast from one side to the other, not just yesterday, but it's happened a couple of times since March. You saw it suddenly go to the long side, then to the short side, then to the long side. And this is the third time we are seeing it gyrate, and probably this one is the fastest. Last time it took 2 days. This time it's like 1 day. Why is it happening? Maybe they're just knee-jerking with every swing of the market. If I compare this to previous elections, what we had seen both in 2014 and 2019, both which were BJP wins, was that the FIs were positioned on the long side. So they're betting on, the continuity part, and that sort of worked out. It's only when they had excessively long positions, the market did pull back even then, but eventually rallied higher. So at the start of this month, we actually had the same situation. You had FIs being short, and that caused a rally because there was short covering. But once that covering is done, we are once again seeing, downward pressure. So what is it that is, concerning? I think possibly this is just a bet on this becoming a non-event because, and by non-event, I don't mean a complete loss, but possibly that, the numbers are very similar to the previous time. You may not see too much change. Maybe that's the bet, and which is why, markets, if they have priced in a very big number and maybe if it's not going to happen, that is what the, market behavior and the positioning may be suggesting in the very short term. But what people should also pay attention to, because like what I said in the beginning, that when you get extreme positioning, you also get trend reversals. And we may not have reached the highest short from FIs, but this is, I think, the 4th highest and also the highest since October. That means 2nd November, I think, was the peak point where you had almost 3 lakh, in fact, 350,000 contracts short. Now you're almost close to 3 lakhs. So this is the highest since, the 2nd of November, 2023. That resulted in that big rally where, Nifty went from, almost just below 19,000 to 22,000. So that was a big move. Now, if after or around the election dates, once all the uncertainty is done, if we do see this positioning still at an extreme, then we would take it as a bullish signal. But as of now, because we are still ahead of the results, it looks like a bet on the event itself and becoming a non-event or slightly negative in the sense that, oh, you didn't achieve the big numbers. But medium to longer term, markets always like stability. We spent all of the 1990s waiting for a stable government, and now the only thing markets want is as long as there's stability and there's continuity, we are okay in the medium to long term. But short term, I think it signals some volatility on the downside because of maybe the numbers won't be met type of thing. But eventually, if that results in a excessive short position, then it will also, give us the reversal that we want medium to longer term later on.
So this kind of ties in with what others have said that, a victory is kind of priced in. So then what? Then after that? So maybe you kind of taper off a little bit, right? That's essentially what you're also saying from a FI and index futures positioning point of view. That seems to be the most.
It's like the buy on expectation, sell on news event.
Right. But nothing. You wouldn't see this as some have pointed out, expression of a view about the number itself, like pre-positioning for that. Pre-positioning in some way, but nothing very large in that sense, right?
Yeah, I mean, they had it right. If I go by the history, FIs were long the last 2 times. They had it right in the near term. Though on the event day itself, after the event day, we actually saw a dull market in 2014 and 2019. So that is where the option traders basically get killed in all of this, because the VIX collapses, right? Right after the event, what happens is the VIX has moved up, almost doubled over the last month, simply because of pricing in market volatility on the event day. And then when the event comes and then the volatility collapses, basically you don't really make much out of betting, one way or the other on the event. The real money gets made only after that, once the markets start developing their own trend. So it's good to really wait this out, because at least for option buyers, this is not a great time. Probably sellers have a better, outcome here. So maybe spreads is what people would consider, where they buy a call, sell a put, and those kind of spreads would actually be better off, because at least you will earn the premium and cover your risk of options decay.
Okay.
But overall, yeah, it results in nothing. Short term, it's just a bet on that. Yeah, if things are just you don't get a very big number change, then market sell off because people just book gains that were based on this.
All right. Hi, Rohit. Good to hear your thoughts this morning. Thanks a lot for joining in. Well, someone asked what's going to take this market higher if the outcome is favorable. It'll be the FIs. Aggressively net short, they get stumped on the wrong side. And the flows as well have been lacking in the past 45 days or so. So let's see how that goes. But since we were talking about the option strategy, if you could fill us in with our strategy, if it's possible. And also the VIX movement. In a matter of a month, it moved from 11 to around 24 odd. In the past as well, I recall even in 2019, we did see this happen. And then it cooled off. A quick comment there.
Yeah, so the numbers, so the change in VIX was very similar. The numbers are different. Like last time, it would have gone from 14 to 28. This time, it went from 11 to 24. So sort of a doubling in the VIX ahead of the event is normal. So it's the same amount of change. It's just that last time you went to 28, 2014, you went to 35. But post the event, in the next 3 days, the VIX came off very sharply. It took 3 days. In fact, I just checked that it took 3 days to come off and then almost halved from there. Like it went back from 28 to 14 eventually. And so that is the option loss. So when you're going to see that kind of an option loss, when you do some kind of a spread strategy where you're actually selling a call or a put versus what you're buying, maybe you buy one call, sell two puts, those kind of strategies actually do better. Or at least hedge you to some extent on the option buying that you do. So you don't really lose much. If there is a move, you have something to gain on the spread. And if it doesn't move much, your loss is limited by the premium decay that you actually get on the option. So that's how one has to think about it.
Okay, thanks a lot, Rohit, for joining in. And a lot of volatility ahead of the election results. In fact, for now, the mid-cap index has moved into the red and, by a large amount. So down 200 points in the mid-cap index. A lot of stocks are slipping in trade. So, just better to be cautious as there is a lot of volatility kicking in. But Nimesh is joining in. He is going to talk about M&M. Remember, we highlighted it as part of our standout brokerage report. And it is one of the big movers today. Nimesh, over to you.
Thanks, Sonia. So, as you said in the morning as well, there was a big upgrade from Boffa Securities on M&M. So, today they have upgraded the stock to buy from neutral and they've raised the target price on the stock to the 3,050, a potential 24% upside from current levels. Now, Boffa sees multiple growth levers and catalysts for the stock going forward in the next 12 to 18 months. They believe that the core business will gain market share in the SUV as well as this year turnaround in the tractor business as well. In fact, they expect the subsidies to contribute more going forward as far as M&M is concerned. So they have a consolidated EPS CAGR of 18% with a 20% ROE, and they believe that valuations at 19 times forward is quite reasonable. So on back of that, a big upgrade to a buy now from Boffa, and they've raised the target price now to 3,050, a potential 24% upside from current levels.
Okay, thanks a lot, Nimesh, for that. Let's slip into a quick break. When we come back, we'll connect with Shiju PV, the senior partner, India Law LLP, and Kumar Saurabh Singh, who's the partner at Khaitan and Company. Stay with us.
Okay, welcome back. There's market under a bit of pressure, but 60 points under pressure from the day's high, but otherwise, looking pretty good. Now, Finance Minister Nirmala Sitharaman has said that the Insolvency and Bankruptcy Code has played a key role in helping banks recover from the NPA crisis. Macquarie, in a recent note, has said that the initial high recovery rates were boosted by large steel sector resolutions. But the recovery rate actually has been falling since. We have a couple of gentlemen with us to discuss this. We have Shiju PV, Senior Partner, India Law LLP, and Kumar Saurabh Singh, Partner at Khaitan and Company, joining in to take this conversation forward. So let me just start by sort of posing what Macquarie in a note is saying. They're saying that the March data by the IBBI reveals that recovery rates over the years have been falling. And as I said in my preamble, the initial high resolutions were led by some large steel accounts, resolutions there. And then, of course, go on to detail a whole many reasons why the rates actually have been falling. Saurabh, if I can start by, gentlemen, good morning. Good to have both of you here. Prashant this side. Saurabh, if I can start by asking you to sort of react to what Macquarie is saying, and if you want to put some of these numbers in perspective. Go on.
Well, thanks, Prashant, for having me. I think, the data that is presented by Macquarie is there for all to see. So, clearly there has been some drop in the recoveries, which you see from the insolvency process. But overall, one has to see it in the context of the framework which has been put in place in last 8 years. You can't just look at 1 year's number. I think overall in last 8 years, the framework has done well. It has helped in the overall resolution environment of the country and for banks to really being able to turn around companies which have been in distress. So in that sense, the figures cannot be looked in isolation. But yes, temporarily, there has been a drop. And I think it requires some intervention both from government and judicial side to really see where the backlog is getting created, because clearly it's the delays which is pulling down the recovery. Even if you look at IBBI numbers, that also indicates that the moment the resolution period goes beyond 1 year, the recovery rates tend to go down. And this is in a way indicator of, say, process running well beyond 30 days, which is what the law prescribes as the time frame for resolution. So as the time period passes, your recovery.
But what is the, in your opinion, Saurabh, in your opinion, what is the main reason for the delay?
I think there are, of course, judicial backlog is one aspect which clearly contributes to the delay. But I won't put the entire blame on the judicial side only. I think all the stakeholders really involved in the process, be it the creditors committee, the way it is functioning, that also has to really take responsibility of being able to take quick decision, because sometimes what tends to happen is that decision making is prolonged, and that tends to eventually cause say disagreements and leads up to dispute, which then ends up in judiciary. So I think all stakeholders need to really sit down and work together to help improve the numbers.
Shiju, your first thoughts on this?
See, IBC has been more or less similar with other kinds of recovery laws as far as recovery is concerned. So it didn't bring much changes as far as recovery percentage is concerned. But we have to see IBC from an overall holistic perspective. The purpose of law is not just a recovery, because there are many laws for recovery alone. So it has to see its purpose is to bring resolution and also to improve the overall credit environment of the country, to bring some credit discipline. I think from that perspective, IBC is working well. So in an economy like us, there are two kinds of default. One is actual business default, which we cannot stop it. But as far as willful default is concerned, the promoters are a little wary now to actually default that kind of a situation. So that's an improvement, I would say. And regarding the reasons, judiciary is always there, but that we have to live with the judiciary. But also from the judges' side, because we have to understand that IBC is not a typical adversarial law. So something like judges has to come out and take an active role in the resolution. That's something is lacking from the benches. Similarly, insolvency professional, they have a very active role to play in overall insolvency resolution process. Somehow the training, their expertise is still lacking, despite more than 7 years we are been in this law.
Okay.
Similarly,
so some of that institutional capacity is yet to be built. But I just want to make compare that, so as compared to earlier recovery rates under CDR, etc., you're saying recovery rates have largely remained same under IBC? So there's not much change, that's what you're saying?
There's not much change.
Okay. But fresh defaults, sorry, go on.
Yeah. As you said, the fresh default, especially the willful default, I think it's coming down because promoters are not really worried. And also we have to understand that the second tier of the IBC, which is personal insolvency regime, is not yet taken off. Only the personal guarantee regime is still effective. So once the personal insolvency regime is also taken into effect, it will bring much more credit discipline in the country.
No, this Macquarie note, and of course the data, as Saurabh also said, is there for everyone to say. They say that 44% of the cases admitted go in for liquidation, and that is a matter of concern. Saurabh, you want to respond to that?
Clearly, I mean, the number of cases going into liquidation is a matter of concern. The time being taken in the process to resolve, even in case of successful resolutions, is also a matter of concern. But as I was saying earlier, the framework for resolution has strong foundations. Today, in last 8 years, we have seen stakeholders benefit out of the process. The banks have really had seen good recoveries in last 7-8 years. Some of these problems, like a lot of cases going into liquidation, could be, say, addressed through time-bound resolution. The amount of time that you take effectively impacts the prospects and in a way brings down the confidence also. So what we see today in Macquarie's report really is an indicator of the fact that today there are problems in the process, but it still may be much better than what we had earlier. And some of these problems from time to time, which has arisen in the process, government has proactively addressed. So in that sense, with the kind of statement which has come from Finance Minister, it's clear indicator that both RBI and government are very clearly looking at this framework to really be a resolution process which helps in quick resolution and helps bank to really manage their NPL problems. So I think some of these issues, including the backlog, capacity issues, the decision making, has to be resolved through continuous dialogue and discussion. And clearly, you will see that NPL numbers for banks is looking much better. At the same time, you have a higher number of cases going into liquidation. In a way, that is, that doesn't compare well together. So I think somewhere the system needs to look into these aspects also and find ways to really minimize the time process spent in the resolution and at the admission stage also, because what we are also seeing is that at the admission stage, anywhere between 3 to 6 months is being taken for admitting companies into insolvency. Now that's the area where I think there is room for clear improvement, and that's the stage where companies need most support. And if you are able to really admit them quickly if they need resolution, then you will see probably reduction in the number of cases going into liquidation.
I mean, greater the delays, lower the recoveries. I mean, I think the data is very, very clear. Saurabh and Shiju, great to have both of you here for that quick chat. Appreciate your time here on CNBC TV18 today. And we'll continue to track this data point and what can be done, as both of you said, that, a lot of things need to come together to build institutional capacity to kind of resolve this in a more timely manner, admission into the process itself, and of course then fast-tracking this so it doesn't see inordinate delays. The market, by the way, has come off. We're about 40 points higher, which means we're about 85 points off the day's highest level. Nifty Bank is flat. Mid-cap index has turned red. And I think the small cap index has also come off sharply from the day's high. It's a wrap on this edition of Bazaar. From all of us here, it's goodbye. Thanks very much for staying with us. Chartbusters will pick up on the action in just a bit.